is not just a UK issue. This bond rout is going global.
It's a big warning sign and it's a red flag, and we should not just assume just because we're in the United States we're immune from it.
The pressure is going to mount on the Fed.
We do think that there's a risk of a financial event that's going to feed into policy decisions.
This is the most challenging fundamental backdrop we've had in 40 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a 24 hours we've got for you to close out the week. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio. Equity futures positive 0.5%. It is CPI Thursday, and that number a couple of hours away, Lisa.
And just to sort of set up how significant this could potentially be, the last time we got the CPI print on September 13th, we saw a 4.3% decline in the S&P, the greatest decline going back to June 2020, to give you a sense of how significant of a reset this number could be.
Fold in the Federal Reserve minutes of yesterday.
Yes.
The risk of doing too little outweighs the risk of doing too much. Do you think that decision, that assessment, is coming a little bit closer into balance as we close out this year?
There is more dissent around the margins, that there is this feeling that perhaps they're getting closer to a restrictive stance and they can start to worry about the financial stability concerns. It was interesting that they didn't give a nod. A nod is basically a generous way of saying they basically touched on the fact that the rest of the world existed in those minutes. And is that the beginning of perhaps a little bit more of a balance with respect to these risks?
Did you see the latest news out of the UK? The Chancellor now saying any volatility after tomorrow is basically over to the governor. Yeah. That's the word to the Chancellor.
He basically said it's your fault. If there's a problem, this is your responsibility, not ours. And, you know, we're going to keep doing what we're going to do. Now, what about you?
It's a matter for the governor.
What I find interesting is that he's saying this from Washington, D.C., because they're down for the IMF meetings, all of them. IMF coming out and absolutely eviscerating them and saying their budget is terrible. And all central bankers are saying right now it's fiscal policymakers' responsibility to really get their world in order. And fiscal policymakers are saying, no, it's you guys.
It's a matter for the governor.
You guys figure it out.
We'll catch up with TK in just a moment down in Washington, D.C. Looking forward to doing that. Equity futures right now, positive 0.4% on the S&P 500. As we go into the inflation day number, you have got a 6-day losing streak on the S&P. Can we break that? At the moment, we're snapping it for now. Yields unchanged on a 10-year, 389.65 on 10s. And euro, just about positive, stronger. Euro dollar, 97.25. Lisa, firmer by 0.2%.
And just to put that into perspective, if we get a 7th consecutive decline on the S&P 500, that will be the worst streak going back to February 2020. This is what Deutsche Bank's Jim Reed pointed out this morning. Very much in focus with respect to that loss or a potential ongoing streak. 8:30 a.m., we do get that key CPI print for the month of September. I'm really watching core inflation. This is going to be stripping out food, stripping out energy. Can we get a new high, the highest levels that we've seen going back decades? What will that mean for a Federal Reserve that might be seeing some relief on the headline number with respect to energy, but not when it comes to rents, not when it comes to other basic expenses that people are paying every day? Today, there is an absolute mess in Washington, D.C. Tom will go through it, but what isn't happening down there? There's the IIF, the IMF, a G20 meeting. I am particularly interested in a couple of interviews done at the IIF with JP Morgan CEO and Chair Jamie Dimon and Citigroup Chair John Dugan. What kind of sense of systemic risk are they going to really highlight, of a sense of not functioning in certain markets like treasuries, for example, at least on the margins? And at 1 p.m., we do get another auction. U.S. is selling $18 billion of 30-year bonds. Yesterday's 10-year auction was not great. And you saw them sold at yields that were the highest, John, going back to 2009. And still there was not blockbuster demand. Do you have the same kind of dislocation on the 30-year front?
As the central banks step away, we've got to ask a broader question. Who's stepping in?
Exactly.
Where does the buying come from and what price? We're finally returning to price discovery without the distortions of these guys. And we're not there yet. This is part of the journey, but it's certainly a very volatile one.
And it goes to the point that you've made. What happens when the risk is in the risk-free asset? How much does that change international markets?
It gets very difficult to price actual risk assets. And that's been the problem of the last several months, arguably the whole year. Tom Keene is down in Washington, D.C. for us right now. TK, it's CPI Thursday.
It's CPI Thursday, John, and in 15-plus years of coming to these meetings, the April meetings and these annual October meetings, there's no question today, John, that CPI, United States inflation, is front and center for every single attendee of the IIF, the World Bank, and the IMF. Today's an important day for us. We'll be speaking with the managing director. She has a full plate of risk and financial instability to discuss.
Looking forward to the conversation, Tom. We're going to catch up with you in the next hour again. Looking forward to that too. What a lineup down in DC, and what a time for these conversations, Lisa.
It's such a difficult time. The message is really interesting from a lot of policymakers, central bankers, who are saying, hey, fiscal guys, it's on you. And the fiscal guys coming out and saying, no, we're going to punt. And how much can this really go on? Somebody has to blink. Who will it be? Joining us now, I'm pleased to say, is Peter Champwell, the head of global macro strategies trading at Mizuho. Peter, fantastic to catch up with you, sir. I've wanted to catch up for a number of weeks now. Can you help us identify the spillover from what's happening in the UK out to international markets, perhaps even US credit?
Yep, absolutely. I mean, the events in the UK have meant that there has been selling of global risk assets. If it's liquid, it's been sold. And that's the transmission that we've seen. And that's why, on Bank of England buyback stories, it has a material impact across US risk assets and risk assets in other jurisdictions. What we haven't seen yet is much by way of fear of replication of the issue that we've got with UK LDI in the rising real rates environment, and that taking place in the US or in Europe. So I don't think that those equivalent investors are anywhere near as large as the UK LDI in terms of their proportion of the domestic market. But I think the mechanisms are the same. I think as we go into the rising real rate environment, that generally the pension fund community is going to be selling assets. They have an excess, a surplus of assets at the moment. As real rates go up, their liabilities go down, and that is going to continue this move, albeit in a much more orderly manner in non-sterling markets.
Peter, how much is this the tip of the iceberg, and how much is this a node of leverage that's been mostly beaten out at a time of incredible turmoil, both on the fiscal and monetary policy of the UK?
Yeah, it is all about leverage. In hindsight, really, this is something that I suspect the Bank of England has been considering when it's been trying to set its monetary policy, because it has always puzzled me as to why their inflation forecast was way below the sort of inflation forecast that I was using internally, and basically why they're having this dovish slant to their monetary policy. I think it's come to bite them now, because they've stored up all of this inflation risk premium, which has eventually meant that given this fiscal surprise from the government, then caused the big blow up in gilts that we're all now experts on. And I think that what we've had in the UK really is symptomatic of what is happening elsewhere, but it's just in the UK, the cost of liquidity is that bit more greater, so the market is that bit more fragile than dollars and euros. So the move has been really exaggerated. Yesterday, but it's not finished, I don't believe.
Well, and yesterday, something interesting happened. Initially, there was a huge sell-off in gilts, and you saw 30-year yields climb to new highs of this particular economic cycle. And then suddenly it reversed, and it came after some sense that the Bank of England was buying with no bids rejected, this feeling that finally they were going to come in basically unbarred by any particular parameters in terms of staving off some of the distress. How much is that going to be what they have to do? Basically going against their mandate of removing quantitative easing and go back to it in order to get financial stability over the longer term? Because, as you said, they are not all the way done with these LDI issues.
I don't think I don't think that they're a price insensitive buyer. Their operational procedures tell us exactly what the price level that they would buy at. It's yesterday's trade went close. And at the moment, with the rally that we've had in gilts today, it should mean that if the market stays where it is, then between 215 and 245, they'll be buying about zero. And then the market could well reverse off that. So it's a very, very technical market. But I think we're still going to be moving away from this financial intervention towards asset sales from the Bank of England. I think perhaps the more important question is, are asset sales of long maturity gilts, so 20-year plus, are they feasible in the environment where the LDI community is still somewhat fragile? I suspect that they're not, and so we may see the quantitative tightening and asset selling program of the Bank of England modified slightly to reflect that. But I feel really strongly that the only way that these inflation problems that the UK has, and basically the twin deficits, we're not we're not the US dollar, is going to be resolved is with much higher real rates. I think real rates need to get up to about 2.5%, and 10-year UK real rates is in the low 1% at the moment. It's got to be above where the dollar market is.
Pete, just to be clear here, I just want to jump in because what you just said is really important. You think QT still starts at the end of this month. Now, I understand you think it's recalibrated, perhaps with shorter dated gilts. But do you also think this gilt market operation ends tomorrow? And if it does, can you tell me what the price action is going to look like? I guess that's the $1 trillion question between tomorrow and then.
Well, I can't see it being worked out without there being more volatility in the market. If this market behaviour continues where the Bank of England is there with a known price level that they're willing to buy at, then I suspect these gyrations are going to be quick today and tomorrow, and we could be quite underwhelmed with how much they buy today. But then come Monday, with that support no longer there, I think the market will struggle to find a clearing level, and we could well have real yields going up higher. Now, the question is, has the LDI community delevered and liquidated enough for them to be able to withstand margin calls? Cover ratios have gone up. They now have a surplus of assets, which is great. I suspect that they could well be rebalanced. And what we can now move into is further sell-off of gilts. I think the 10-year nominal yield probably gets to 5% without it causing distress for the LDI community going forward. But it still means that rates have to go up to a much higher regime.
Hey, Pete, we've got to leave it there. Thank you, sir. Peter Chatwell of Mizuho. Very relaxed about something that sounds pretty crazy in many ways.
It's so understated. He's like, there'll be more volatility. Other people are saying, it's going to crash the market. They're going to have to come in with something
How many
insane.
People have you heard say that they think QT actually happens at the end of this month?
Very few people. People saying they're going to have to reverse it. So fascinating moment with a moment of calm there.
Yeah, gilt's rallying this morning, that's for sure. We're down about 12 basis points on 10s, on 30s. We're down 18. In the next hour, we'll catch up with Katie Kaminsky, the Chief Research Strategist at Alpha Simplex, as we count you down to the CPI report, 8:30 Eastern Time, a couple of hours away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. The International Energy Agency says OPEC's decision to sharply curtail oil production threatens to push prices to levels that tip the global economy into recession. The head of the IEA Oil Market Division spoke to Bloomberg.
We're not calling on OPEC we're not setting their policy. Obviously, this is for the OPEC to decide. What we're saying is that by cutting supplies to the market, it's preventing a rebuilding of inventories that are still critically low.
Demand is now expected to contract by 340,000 barrels a day in the fourth quarter. The U.S. is considering a total ban on Russian aluminum in response to the military escalation in Ukraine. Bloomberg's learned that the Biden administration is weighing a number of options, including an outright ban or a large increase in tariffs. Prices surged to a record in March after Russia's invasion. Russia is second only to China as a producer of aluminum, which is crucial to most heavy industries. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
So by moving at an aggressive but not an overwhelming pace, it allows us to get the funds rate up, to signal our commitment to keeping inflation in check and bringing it back down to 2%. But it also gives us some time to see how the economy is unfolding.
Fed speak is my favorite. That was Neil Kashkari of the Minneapolis Fed. Lisa, what's the difference between aggressive and overwhelming? What's the difference?
What's the difference between financial stability and price discovery? I mean, honestly, all of these things, it's very difficult to know.
If someone's aggressive to you, isn't that slightly overwhelming?
It depends. I mean, if they're aggressive with the thumbs up.
The Fed speak drives me nuts.
I know.
We're doing this aggressively, but it's not overwhelming, I promise you.
Well, this is again the difference between when does it become a financial stability problem, and the line is a lot thinner than people had realized when you talk about what the pricing is and what financial stability is. Hard to know what the differential there.
CPI coming up in 2 hours and 12 minutes time. Going into that number, the price action shaping up as follows on the S&P 500. 6-day losing streak on the S&P into Thursday. Futures up this morning by 0.4%. Yields unchanged at 389.85. Euro dollar, slightly stronger euro in the mix here, 97.31. Firmer on that currency pair by 1/3%. Crude 87.40, up by a little more than 1/10%. Have you seen the statement from the Saudis?
Yeah,
I mean,
was just
come
reading it.
on. They are not backing away at all. Listen to this quote here from the Saudis. I'll read you the full paragraph. The government of the Kingdom of Saudi Arabia would also like to clarify that based on its belief in the importance of dialogue and exchange of views with its allies and partners outside of OPEC Plus and the group regarding the situation in the oil markets, the government of the Kingdom clarified through its continuous consultation with the US administration that all economic analyses indicate that postponing the OPEC Plus decision for a month, according to what has been suggested, would have had negative economic consequences. The Saudis right now are telling us that the US administration requested a 1-month delay to the decision. Now, the calendar's not lost on anyone.
Right.
It's the midterms next month.
Okay, so on one hand, this is Saudi Arabia either throwing President Biden under the bus or showing that he's politically motivated and that any of his job owning is politically motivated. On the flip side, you also got an IEA, an International Energy Agency report out this morning, parroting what the administration has been saying, that OPEC Plus, the fact that they're cutting production right now risks a price spike. Is this a matter of geopolitical fragmentation with alliances getting on either side, or is this an issue of perhaps OPEC Plus, as you've pointed out, being the plus the Russia alliance, given the time and the conflict with Ukraine?
Will Kennedy joins us now out of London, Bloomberg's very own and one of our best. Hey, Will, it's not getting any calmer, is it?
No, this rift between Washington and Riyadh is plain for everyone to see. A war of words, a diplomatic spat, however you want to phrase it. It's pretty extraordinary for them to put out a public statement showing the inside of their diplomatic relationship with Washington, and it suggests a lot of bad feelings on both sides.
And what does this mean in terms of what the reality is? I mean, who do you trust, Will, in terms of who's the correct actor in response to supply and demand, and who potentially is either politically motivated or acting out of a lack of capacity to produce oil, even if there were an increased demand?
Well, I think that both sides can credibly argue their position there. Saudi Arabia is keen to keep prices strong and very worried about the potential impact of monetary policy and the slowdown in the global economy, and thinks that the prudent thing to do to ensure stability in the markets is to cut now before you're faced with oversupply. On the other hand, Washington will see it differently. Biden has been incredibly focused on gasoline prices and in fact achieved a lot. Prices fell for a number of months. It will be worried about that reversing, and it's very concerned and has made clear its concern about the potential of a price spike over the winter as Europe grapples with its energy crunch, putting demand on oil too, and as European sanctions on Russian oil kick in early December. A big change to the way the global oil trade works.
Well, amid this political fog, and frankly the fog of different idiosyncratic markets, with the diesel market prices still surging on the heels of lack of refinery capacity, there's a question of just what the inventories look like. And I point to the IEA report showing that in developed nations, inventories are 243 million barrels below their 5-year average. Can you give us a sense of how significant this is, how vulnerable this makes developed nations heading into a winter where there are a lot of questions about capacity to supply a lot of the developed world?
I think a point that the IEA and as a representative of consuming nations, including the US and Europe, would make is that with inventories that much lower, it's an odd decision for OPEC to cut back on production, and the IEA has clearly highlighted the risk of inventories falling through the winter and into next year, and the vulnerability to the market. Diesel is a particular problem, and I think it's something that people need to be very alive to. It is a lack of refining capacity, and that's being exacerbated right now in Europe by strikes at French refineries. The market is very sensitive. There was a flaring incident at a big refinery in Holland this morning, and that kind of thing gets people jumpy when you're operating a system at maximum capacity. Accidents and unexpected incidents matter. Now, that tightness exists in the US as well. There's a lot of concern about diesel stocks, especially in the northeast of the US, where heating oil is used to heat homes. And a lot of diesel is going from the US to Europe. So it's a difficult situation, and I think we've seen different parts of the energy complex flare up over the last year. Diesel is somewhere where we need to concentrate our attention in the months ahead.
Well, just a final word on the SPR. This administration has drained the SPR to 4-decade lows. They've accused OPEC Plus of being short-sighted, but I just wonder if that accusation could be levelled at this administration as well. Aren't they now more exposed to the whims of OPEC Plus next year because of how much they've drained the SPR this year?
Yeah, it's the problem of fighting a issue of flow with stocks. Your stocks run down very quickly, and you can argue that the SPR intervention in some senses has been successful. At a time of turmoil in energy markets, it has kept gasoline prices low. But of course, as you say, John, there is a downside, and to use a metaphor, they will run out of bullets. So they need to hope that next year there is a bit of give in the oil market, that maybe OPEC has another look at the market, or new supply comes on from elsewhere. But at a time when shale production appears to be slowing, it is a difficult, perhaps, situation ahead.
Will Kennedy, thank you, sir. Out of London, incredibly difficult, very complex, but the decisions that are being made now arguably make things more fragile next year. Same not just for the OPEC Plus decision and the oil markets, but also for gas in Europe.
Right. We
keep treating this stuff as a one-off shock, yet at the same time, the politicians are telling you that it's a huge permanent shift away from Russian energy as a source. So you have to ask yourself, how viable are some of these policies coming out of these countries, Europe as a region and America as a country?
Well, and this is the reason why the IEA pointed to the storage capacity and the fact that it's come down so dramatically, or the storage, the inventories have come down so dramatically around the world. But at what point, and I feel for policymakers in this capacity, because they don't want there to be a complete recession in the face of surging household prices for oil and gas. At the same time, how quickly can they really bring other supplies online?
Are viable energy policies consistent with getting re-elected? Viable long-term strategies over energy, are they consistent with getting elected on a very short-term calendar?
Well, this is the problem, and probably the reason why there hasn't been that kind of investment. And now, can they make the investment with money that is a lot more expensive to borrow?
Live from New York, this is Bloomberg. Inflation data 2 hours away in the United States of America. Live from New York City this morning. Good morning. It's the price action on the S&P. 6 days of losses into Thursday. We are positive by 0.5% on the S&P. On the Nasdaq, we're up by 0.2%. We are going to be hypersensitive to the inflation print 2 hours from now. In the bond market going into it, 2s, 10s and 30s shaping up as follows on a 10-year yield. Your yield right now unchanged at 389.85 on a 2-year, just short of 430, just short of the highs of the year at 429.53. Lisa, core, that's the focus. Core month over month for Wall Street. As we often say, the front pages will go with headline year-over-year CPI. We're looking at core month over month. And I have to say, the expectations on Wall Street, they're not looking for a major pullback, are they?
No, they're looking for actually potentially new highs of the past 4 decades in terms of core inflation. And because of some of these longer lagging types of indicators like rent. So then what's the response in markets, right? The last time we got an upside surprise, markets sold off at the fastest pace going back to June of 2020. Is it the same, or is suddenly it's not necessarily clear what the Fed does with this other than what they've already communicated?
You'd have to imagine if we get a significant downside surprise, this market's like a springed coil.
I think that you're probably right.
Given the damage that it's been inflicted on this market over the last 6 months or so, not just for this market, but for the gilt market too. Believe it or not, the Treasury market guided by what's happening with the gilt market too at the moment, and I think you will understand why. Yields on gilts at the moment, on a 30-year, down by 19 basis points, 463. The volatility in that market, I don't remember it being this volatile. The Chancellor had this to say late yesterday evening in Washington. Any fresh turmoil in markets would be, quote, a matter for the governor. At least a matter for the governor. I mean, what a line from the Chancellor in a difficult moment for this bond market.
that a lot of people, including the IMF, and you can argue that it was perhaps out of their mandate to be able to say this, a lot of people point the fingers at the budget, that this is their issue. This has nothing to do with the Bank of England and their decisions, at least over the near term. It's everyone's issue now. Martin Will joins us, the Professor of Economics at King's College London and former Bank of England Monetary Policy Committee member. Martin, fantastic to catch up with you. Let's start broad and let's start here. How difficult is it to preserve financial stability and address inflation simultaneously?
Well, historically, of course, it has been possible to address inflation and preserve financial stability. The difficulty we're seeing at the moment is that the Bank of England is having to try and manage the chaos that the government has been creating in the bond market. What the Bank of England would normally do would be to put up the bank rate to manage inflation. And of course, that doesn't feed directly through to the 30-year rate, but it's at the long end of the market where we've been seeing all these problems. And it's at the long end of the market that the implications are greatest for the pension funds, of course.
Martin, do you think that this Bank of England can really start quantitative tightening with the financial stability concerns that we've seen?
I must say I do wonder. Certainly, you might say, why be buying in a lot of government debt in October to start quantitative tightening slightly later? So we may see a pause on that at the MPC meeting, or possibly hear earlier about that. And of course, if that happens, then the argument for raising interest rates a bit more becomes all the stronger.
Do you think that Governor Bailey has messed up in terms of communication over the past 2 weeks, given the back and forth of, possibly talking with clients or talking with big investment firms in back rooms and saying perhaps we could extend the program, the emergency program, coming out with additional emergency measures, and then with a shock warning saying you guys have 3 days left, just to remind you, get your ducks in order, creating a bit of chaos. Do you think that he created an unnecessary degree of confusion in markets?
Well, I think he's been trying to manage an extremely difficult situation. Of course, where we will be if the problems do continue next week is unclear. My guess is that the Bank of England will have up its sleeve some form of more targeted intervention, but it is very much saying that the pension funds that need cash can raise cash in favourable circumstances at the moment. And my guess is that if they don't, then the Bank of England might make cash available, but on less favourable terms.
Martin, we've talked a lot about how resilient the system is post-GFC. I wonder if we look at this episode of the last couple of weeks and ask ourselves questions about how fragile it might be. Martin, a lot has been said about this administration, this government in the UK, a lot of criticism worldwide. It's all been pouring in. But Martin, what are the lessons we need to learn about how fragile, how resilient the system actually is?
Well, I suppose what none of us had expected would be that the system would face the sort of political economic shock that we've seen from Liz Truss's government. The assumption had been that the institutions were strong. Well, they have reasserted themselves, but the damage has been done. So, my view is that what we've learned is that if you get a government that pursues, say, very idiosyncratic policies, then you can have problems. And that's the sort of issue that perhaps people designing institutions hadn't thought of trying to protect themselves against.
The Bank of England is now in a very, very sticky spot. We're looking at the commentary coming from the governor, and I get the sense, Martin, I wonder if you share this view, that they seem to be very sensitive about contributing towards perceived fiscal dominance. And Martin, in a way, I wonder whether there's a risk here that they overdo it, trying to push back against that, and abdicate some of their responsibility when it comes to financial stability. Martin, can you walk me through how you gauge that kind of thing, that dynamic, those dimensions over the last week or so?
Well, I think everything is a tightrope. Obviously, at a time when inflation is high, the Bank of England must have been extremely unhappy about introducing measures that, for all the different circumstances, look in their structure very much like quantitative easing. Because, as we know, quantitative easing adds quite a lot to demand. It was intended to add to demand, and it works. And the Bank of England is certainly extremely nervous that, people might think, politicians might think, that it's going to put a lid on long-term interest rates in the long term. And if you do that, it does look very much like fiscal dominance. The function of the Bank of England would then become to provide the credit that the government needed, instead of what's established in law and practice, to control inflation. So the Bank of England is extremely nervous about that, and with good reason. They want the focus to be on their monetary role, controlling inflation, and they don't want anyone to think that their job is to get the government out of self-created difficulties.
So they've got to choose the lesser evil now. And I think that's really difficult, Martin, because they're stuck between a rock and a hard place. I'm sure you'd agree with that. If financial stability requires some kind of permanent facility from this Bank of England, are we sitting here and suggesting they may not be willing to provide it because they're too worried about how that might be perceived?
Well, insofar as we think of the problems with pension funds, of course, high interest rates actually make life easier for pension funds in the longer term. The problem is liquidity, at least as I understand it. And to the extent that the problem is liquidity, there are a number of ways in which the Bank of England can provide liquidity.
Martin, just final question. The Bank of England decision on November 3rd. As a former policymaker, let's put you around the table again. How would the events of the last month influence your decision about how big a rate hike we need?
Well, I think one thing that's going to influence decisions is what's actually announced in the fiscal statement on the 31st of October. And I think it was very deliberate that that's ahead of the MPC meeting so that the MPC can take that into account. But suppose in those circumstances the Chancellor doesn't offer any coherent way of balancing the budget, then I would be inclined to a stronger interest rate increase than would otherwise be the case, because, of course, an unbalanced budget is adding to demand in the economy. The Bank of England needs to restrict demand in order to bring inflation down.
Martin, I'm sure you wish you weren't on this MPC, that's for sure. Very lucky, fortunate perhaps. Martin Will, thank you, of King's College London. Can you imagine being on this MPC right now?
Well, when you were asking really good questions and important questions about facilitating their monetary regime or their fiscal regime of this particular administration, how much can central banks push back against the past 2 decades when they facilitated the borrowing binges of administrations around in the developed market?
But inflation wasn't a problem then, right?
But that's correct. So at what point can they stand up to the fiscal regime and say, this is your problem, and oh, by the way, if we have a financial stability problem, we're not going to step in because we can't, because inflation is a bigger issue and that is our primary mandate. What's their sort of correction mechanism with fiscal authorities at a time when the fiscal authorities are saying, actually, central bankers, it's on you, it always has been, so go for it?
They have a duty to provide financial stability. If markets aren't functioning, they have a duty to do something about that. And their concerns about perceived fiscal dominance, surely they would have to be set aside to fulfill their obligation to stabilise market functioning. You can't just abdicate that because you're worried about how decisions elsewhere might be perceived.
But it's not necessarily abdicating. There's a question of whether they can, right? Are they basically burning cash through a feudal enterprise of trying to create financial stability while doing something at the same time of combating inflation? How much is that what we're seeing right now in the United Kingdom, where they didn't get the response of people actually selling in bulk and remedying the issue quickly? And now they're stuck between a rock and a hard place of whether to extend some sort of emergency program indefinitely, even if there's no take-up, just as a possible cushion, and then not be able to do quantitative tightening.
This goes back to the first question we asked of Martin Wheel. How do you balance financial stability concerns with addressing inflation? And many people have said it's a challenge. Other people have said it's possible. Others just say it's almost impossible.
And how much does it politicize central banks that have only been successful with a significant modicum of independence? And this is really going to be a huge issue also at a time when there is this call from central bankers, please, fiscal policymakers, reduce your debt, make our job easier.
Given the size of their balance sheets, given everything they've done in the last 10 years, the idea that they weren't going to take stick from policymakers, politicians, elected officials was ridiculous. We had many people warning of that for the last decade, haven't we? I think you were one. You've been warning about that for a long time.
Well, look, and now the roosters are coming home to roost, or what is it? The chickens are coming home to
something
roost.
like that. I think you can rethink
the
that.
Capons, the capons are coming home to roost.
What are they called?
That's another.
All right, let's go. Futures up 20 on the S&P, up 0.5% from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, the Kyiv region was struck by Iranian-made drones this morning as air raid sirens rang out across much of the country for a fourth morning. Airstrikes also continued in the south. Meanwhile, allies in Brussels for a NATO defense ministers meeting are expected to offer more air defense capabilities for Ukraine in face of Russia's stepped-up missile strikes. UK Chancellor Kwasi Kwarteng says the Bank of England will be responsible if markets suffer renewed volatility after the BOE's bond buying program ends on Friday. Asked about possible turmoil, he said that's a matter for the governor. Prime Minister Liz Truss is under pressure with her Conservative Party to backtrack on much of her tax plan, which roiled UK markets. Hong Kong is said to be considering easing property taxes and visa restrictions as authorities seek to curb the pandemic brain drain of recent years. Bloomberg has learned Chief Executive John Lee could include the measures in his maiden policy address later this month. Hong Kong's strict pandemic measures have seen it lose ground to Singapore as an international financial hub. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
If we do not see signs that inflation is moving down, my view continues to be that sizable increases in the target range for the federal funds rate should remain on the table. However, if inflation starts to decline, I believe a slower pace of rate increases would be appropriate.
Does it end next week?
I think so. I think
does
it's
on the one hand this, on the one hand that?
Yeah.
Governor Bowman there of the Federal Reserve.
Well, does it end after the CPI report? Do we get a sense of, well, you're saying end in terms of the quiet period,
the Fed
right? You mean, you just want a quiet period. You're like, please, just, enough already.
BlackRock assets down 16%. Hardly surprising, given the state of this market, right?
It actually underwhelmed people. People hadn't expected this degree of outflows. And the interesting thing is when you have stocks and bonds both selling off and you have this question about indexes and whether they'll work, how much are we going to be talking about over the next decade or so about whether indexing is perhaps an obsolete model at a time when a lot of the leadership, big tech, perhaps cannot participate in the way that they have in the past.
And passive doesn't dominate in the same way.
Correct.
Market cap weighted indices in a world like this one with higher interest rates doesn't work in the same way.
And what will be really compelling will be how much does that narrative stick, even as we get a recovery if we do get the Fed lowering rates and going back to
Stock not doing much in the pre-market, and we can pick up on that a little bit later. Futures right now on the S&P up by 5 or 0.6% on the S&P 500. Down in D.C., some of our best in Washington all week. I'm happy to say Tom Keene has got a great guest with him. Hey, TK.
Oh, John, good morning to you. It's fabulous to have John Lipsky here. And watching him wave, he looks like King Charles, John, in a motorcade, waving to everybody in the early morning here coming in to the International Monetary Fund. He's a former first deputy managing director at the IMF, but far more. His public service for America and international economics is noted. We start strong today as we move to the managing director later this morning. Dr. Lipsky, thank you so much for joining Bloomberg.
It's always a pleasure,
You were
Tom.
the only one breathing who actually was at Plaza Accord. Everybody out, the media's having a media frenzy. We need another Plaza Accord in that. I don't want to go into a long discussion on this, but how do you respond to people that say we need 1982, 84, 85 again?
People forget the role of the Plaza Accord. The markets had started taking what was perceived as an overvalued dollar down beginning in February of 1985. The issue at the Plaza was, were the major central banks going to try to stop markets from taking it lower? It wasn't to initiate some new movement in markets, and in Plaza they decided, no, we're happy with it going lower.
Right.
Later, they tried to say at the Louvre Accord,
yeah,
stop, that's enough. markets paid no attention and carried on.
Let's go from the time of Salomon Brothers through all of your work to where we are now, and the common theme, and I go back to your important Hanoi speech when you first joined the IMF, is accord. And one of the things about Plaza Accord is everybody was on the same page.
Exactly.
You would suggest that the distinguishing feature right now in this crisis is the discord that you note.
Yes, or put better, everyone's focused on their own problems that they perceive are somewhat different than the others. There's a sense, yes, we have to fight inflation, yes, etc., but the sense of collaboration and effective cooperation that was present, for example, at the global financial crisis, is notable for its absence right now.
If Ian Bremmer says it's every nation for itself, so here we are, we're taking examples. The chaos in Britain now is noted. Has that surprised you?
Yes, of course. But it all goes to show they're in the markets, when you put them under stress, you find faults and weaknesses that hadn't been perceived previously.
What are the faults and weaknesses in the United States right now? We sort of we have the value of the dollar.
Yes.
It's in the seigniorage of the dollar as well. We seem to have an easy road right now. Do you believe it is?
Relatively speaking. And it's, of course, in exchange rates, it's always relative to what? The U.S. is self-sufficient in energy, is a major commodity producer, and basically doesn't seem to have the same kinds of demand problems that others do. So it's, in relative terms, the problems seem tractable. So it's not so surprising that the dollar's been going up.
The key point now, and this is your wheelhouse, if you look at dollar strength and the weaknesses in emerging market, is it the same as before? Are there ghosts of the 90s here? Or what is the distinction now of peso, Philippine peso near 60, Korean won moving up as well, and the others?
Back then, in the 90s, there was a lot of borrowing by emerging economies in foreign currency, especially the dollar, hence a heightened sensitivity to movements in U.S. interest rates. That's still present and that's still important, but it's in the broader context of the global economic developments that is creating problems for some emerging economies, not all emerging economies, but many of low-income economies that don't produce energy and import commodities and have dollar debt or foreign currency debt are in a bad
John
place.
and Lisa, I want to get out front here with Dr. Lipsky today. And my first question to the managing director, we're going to go mathy here, which you can do out of Wesley. The Wesleyan math was killer years ago. To me, it's all about the x-axis, and everyone's going so fast. Have you been surprised at the urgency of central banks to get up to a legitimate real interest rate? Are they moving too fast, trying to get too much done too quickly?
We'll only know that in hindsight. What's clear is they were slow to get off the dime, and now they have to act in a way to convince markets that they're really serious about maintaining anti-inflationary policies. So they're rushing to get to a place that they think they want to be.
They're rushing. What's the damage of rushing?
Oh, the damage could be too fast or too far. But we have to realize that a year and plus ago, no one saw the surge in inflation coming.
Right.
So our understanding of the process of price formation is clearly deficient right now.
John Farrow's in my ear saying we're out of time because it's inflation day in America. Yeah. It's inflation Thursday.
Yeah, but remember, that's a backward-looking number, and what counts is forward-looking.
I'll let you tell John Farrow that. John Lipsky, thank you so much. And keep waving at people as you walk by here. I think they want you to come back. John Lipsky with us here, the former First Deputy Managing Director of the IMF. His public service to America is noted. John, it is Inflation Thursday.
It is a backward-looking number. Tom Keene, thank you, sir. TK on the latest down in DC. Wonderful conversation. Should we tell everyone that at the top of the next hour? What you get at 8:30 Eastern Time is irrelevant. It's backward looking, except that's what this Fed responds to now, and that's why it's so important.
And that's what markets are going to respond to as well. So that's why it's also so important. So how much is it backward looking, and how much are the tea leaves of what's to come and the trajectory and the momentum behind certain indications? People looking, for example, at used cars as a way of getting a sense of how much consumer appetite is declining, and how much does that sort of link into the story that we have been talking about with assets falling? We were just talking about BlackRock.
Sure.
The assets falling, this idea that people feel less wealthy and they're going to do less with that.
It's the compositional story of CPI that matters to pretty much everyone, particularly for earnings and for margins too. What part of the inflation story fades and what sticks? And if these companies lose pricing power at the same time wages remain sticky, then we've got a problem for earnings, right? Margins are going to be difficult, and a lot of people on the equity side are delivering that warning going into this earnings season and very worried about the guidance that comes with it for the next quarter and for next year too. Live from New York, inflation data about 95 minutes away. This is Bloomberg.
This is not just a UK issue. This bond rout is going global.
It's a big warning sign and it's a red flag. And we should not just assume just because we're in the United States, we're immune from it.
The pressure is going to mount on the Fed.
We do think that there's a risk of a financial event that's going to feed into policy decisions.
This is the most challenging fundamental backdrop we've had in 40 years.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
CPI data 90 minutes away, live from New York City. Good morning, good morning. For our audience worldwide this morning, this is Bloomberg Surveillance on TV and radio. Here in New York City, alongside Lisa Abramowicz, I'm Jonathan Ferro. Equity futures negative 0.5%, or rather positive 0.5%. So used to saying negative because we've had 6 straight days of it coming into Thursday.
And if we have a 7th, it'll be the longest losing streak going back to February of 2020, just to give you a sense of how unusual, hitting the lowest levels since late 2020 yesterday, yet again.
We say this often, that the headline number on inflation is for the front page of the newspaper, that core month over month is what this market is focused on. Let's start with core.
Core is going to probably increase. That is the market expectation. If you start to feel that perhaps we've seen peak inflation on the headline number, but not necessarily in the core, what does that do for the Fed? Does that mean that they have to be more aggressive and kind of squelch those voices on the outside saying, oh, we're getting a little bit worried about what's happening with financial stability?
Looking for another 75 after this, ultimately?
Ultimately. People are looking for 75. There is a greater number of Wall Street analysts who are pointing to perhaps a 50 after that, but we will have to see what these numbers say.
Is the step down bullish if the economy rolling over with it?
So Ben Laidler was saying that that's actually going to be the light at the end of the tunnel, and then Mike Wilson says that that light at the end of the tunnel is freight train coming straight at you.
I love that line from Morgan Stanley. It's wonderful.
It's poetry.
If you're very bearish, like someone
like me,
futures up
totally
0.5% on the S&P 500. Cross-asset price action looks a little something like this. And the bond market shaping up as follows. Your yield's coming about a basis point, 388, 83. You got those complaints about stop being so bearish. And I'm like, what would you prefer? That I was bullish all year
and be wrong?
And be wrong.
Yeah.
And like just pretend everything's okay.
Well, if you'd been bullish, maybe everybody else would have made some profits.
They're not my views either. I'm just literally just bringing the view from, say, Morgan Stanley who's saying X and comparing it to the bulls who have been wrong who are saying Y.
It's your fault that people lost money today.
Ridiculous. It drives me insane. It drives me insane. I'm flattered that people think I even make a difference. So let's leave it at that.
Perhaps the way that we see the CPI numbers come in will give people a bit of a reprieve, maybe, although I'm actually struggling to understand what the market response could be that would be overwhelmingly positive unless we get an incredible downside surprise. U.S. September CPI report comes out at 8:30 a.m. We are watching core. The expectation is for it to rise to 6.5% from 6.3% year over year. An upside surprise could potentially cause significant pain, and a downside surprise, again, we will question, does this mean that the economy is rolling over very quickly? Is this a positive thing or a negative thing? Today, who is not in Washington, D.C.? Global finance leaders, public and private, all there for the IIF, the IMF, a G20 meeting, and much more. Among the people who I'm watching, JP Morgan CEO and Chair Jamie Dimon and Citigroup Chair John Dugan, both speaking at 2 and 3 p.m. respectively at the IIF. How much do they give a forward-looking indicator? I mean, we are going to have a backward-looking indicator of the CPI. Earnings, very much a forward indicator, particularly with respect to how fragile some of the financial issues are becoming. And at 1 p.m., the U.S. is planning to sell $18 billion of 30-year bonds. And this follows yesterday's auction that was not great of 10-year notes. And people really did not step in, even though the yields were the highest since 2009. Do we get a similar kind of tepid response to this auction, especially given what we're seeing, John, over in the United Kingdom?
Did you just do a bond auction just for Tom?
I always do a bond auction just for Tom. I mean, every day I see it, I'm like, yes, I can make him go a little nuts.
We sent him down to Washington. I think we sent pretty much everyone down to D.C. this week. TK, walk us through what's coming up this hour.
I'm going to walk you through this, John. I thought your Peter Chatwell conversation was absolutely fascinating, and you nailed it with him where he tried to game out where the real rate is heading to. That's also the major focus of the managing director of the IMF. We'll speak to Dr. Georgieva here later. This is an extraordinary meeting, John, by far and away the most tension-filled one since 2008. But as you heard from John Lipsky, it goes back further than that. With Georgieva, John, I thought the Chatwell, when you stopped Chatwell in this conversation, John, I thought that was brilliant about, okay, how do you get out to a 2.5% real rate?
I don't know how you get out a single month from here, Tom. Can you get out a couple of weeks? Tom, tell me how the ability of these policymakers in DC, are they able to look out beyond 3 months? What does next year look like to them?
They are able to look out beyond. No, they don't know what's going to be out there 3 years, but they're trying as hard to say we can't be certain out 6 months or a year. And that's where you get the fury about the British challenges right now. They just don't need these little crises along the way of bad theory. That goes to the letter that Georgieva wrote to the United Kingdom here a number of days ago.
I know you're going to be talking about that, Tom. Looking forward to it. TK coming up with the IMF Managing Director a little bit later. Coming up with the World Bank President as well later this hour. Looking forward to that conversation. I've been excited for this one. Katie Kaminsky joins us now, Chief Research Strategist at Alpha Simplex. Katie, you're also a PM. Can you tell me how you've done so far this year?
Just under 50%.
Up, positive.
Yes.
How on earth have you done that?
We're bears this year. So I'd say you were talking about the bears and the bulls. It has been an extremely trending environment this year. So you've seen very strong asset class trends. So those of us on the systematic space, those that are following momentum and are able to actually short and adjust our positions, have found really interesting opportunities for those that can actually or are willing to take those type of positions. I mean, we've talked about the short bond trade all year. It hadn't worked since 1994. It continues to work, and it's been the biggest theme this month or the last few weeks.
So based on where trends are right now, it's getting a little choppier. Is it getting harder to really have a full bearish narrative at a time when a growing number of investors are starting to get bullish, at least vocally, about long bonds?
That's a good point. But look at what we just saw. I mean, we're also seeing volumes down. People are really hesitant. That means they think the market isn't oversold yet and that we're not going to hit the bottom yet. I think that's why you're seeing people so hesitant this week in the last recent periods, because we've seen correlations so high across assets that the market is focused on one theme: inflation, rising rates, and nothing else. That's really manifesting itself in the way that asset classes are behaving. And you're really seeing this whole market polarized on one number, which seems silly if you look at the big picture, but it really is the central point of where are we going? What's
Katie,
the next step?
A lot of people talk about the difficulty in liquidity and liquid conditions right now. How much is your strategy amenable to a significant amount of assets versus being nimble? In other words, does size matter when it comes to earning 49% so far this year?
So we trade in the futures markets, and futures markets are some of the most liquid markets out there, and they're a good place to actually realize and sort of take different risk exposures, particularly in the fixed income markets. Now, trying to short cash bonds is a much more difficult proposition because you have to borrow those bonds. There's all sorts of issues with the leverage and sort of credit, personal credit, whereas futures markets are a place where most people go when they have a view. If they have a view that the bonds should go down farther and yields should go up, they go there. And that is sort of a general mechanism of a very functioning market.
Katie, a lot of the time people become married to the view they have in a market, particularly when they're rewarded for it over a year like you have. Katie, can you help us understand the process that you'll go through to understand when you need to make a move the other way? Do you have a checklist? How does it work?
That's a good point. And this is something we get a lot of questions about as systematic traders. Our main goal is not to have bias. And I think what's been the most fascinating to me this year is how much people have long bias to bonds and how they've never thought about bonds going down. And so for us, the goal isn't necessarily to decide what should happen. It's supposed to be focusing on what is happening. And what is happening now is very extreme. And you're seeing very strong bearish trends across across multiple asset classes, something that for most people is very uncomfortable based on what they're used to over the last few decades.
With really strong positive correlations cross-asset, do you see that breaking down, Katie, at the moment? What are you seeing?
We've seen actually a big spike in the last 2 or 3 weeks, particularly in currencies and fixed income. You've seen the volatility in those two sectors spike significantly based on the theme that I just discussed. You're also seeing correlations on the order of 40% over short intervals, something that is sometimes negative. So you're really seeing the whole market in a shorter term horizon focused on one theme. And I think depending on how the numbers go today, you're either going to see that get a little bit dissipated because people realize the fear that they were looking for, or you see it accelerate because it confirms the things that they are willing to be, that they're afraid of. So that's why today is a big day in markets for the U.S.
Katie Kaminsky, congratulations on the year so far. And let's catch up before the year is out of Alpha Simplex. Just phenomenal performance from her and the team.
Yeah,
absolutely phenomenal.
And she was talking about the correlations, and I was looking at data yesterday that showed that the link between the S&P 500 and the Citigroup Economic Surprise Index is the most negative correlation going back to 2015. Basically, bad news or good news is the most bad news for markets that it's been going back to 2015. And it just sort of shows exactly what she's talking about. The correlations are getting that much more entrenched as people kind of are more and more married to their views and look to the data to kind of confirm them.
Everyone's worried about everything. I think it was Boaz Weinstein at our conference here at Bloomberg talking about that just yesterday. Some of it resonated with me because I wonder what we're going to worry about more in the new year. Is it going to be inflation still? Or do we start to focus almost exclusively on growth and growth rolling over? That's been a question we've asked through the whole of this summer. Still inflation, inflation, inflation. Does that change, adapt just a little bit in the next few months?
It's nuanced because if there is also inflation, how does this market respond to stagflation? How does this market respond to a Fed that cannot come back in? Because, yes, growth is waning, but inflation is not coming down quickly enough to really justify any type of slowdown by the Federal Reserve. And that's the worst case scenario. The best case scenario is some of the supply chain constraints getting eased up, as you've talked about, and that would create a much more benevolent picture.
Equity futures look like this, positive 0.5% on the S&P 500. Yields basically unchanged on a 10-year. On a 10-year this morning, going pretty much nowhere. Your inflation data, 1 hour and 19 minutes away from New York. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. BlackRock's profit fell 16% in the third quarter, along with equity and bond markets, as central banks continued raising interest rates to counter surging inflation. The world's biggest asset manager says the firm oversaw $7.96 trillion as of September 30th, the lowest since 2020. At least 15 countries of the NATO military alliance, including the UK and the Netherlands, have signed a letter of intent to join a long-term German project to create a European anti-missile shield, boosting protection for much of the continent. The system will have several layers to intercept various kinds of missiles from different heights. NATO defense chiefs are in Brussels today for a second day of meetings. Nigeria is considering restructuring its debt and extending the repayment period of its credit obligations. The country's finance minister tells Bloomberg the government has appointed consultants to advise as it faces rising debts.
We have just appointed a consultant to make an assessment of how we can be able to get additional relief by way of restructuring and stretching out negotiating to stretch out the repayment to longer periods.
Ahmed says the government also plans to refinance domestic debt obligations that are due this year and next. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
What's clear is they were slow to get off the dime, and now they have to act in a way to convince markets that they're really serious about maintaining anti-inflationary policies. So they're rushing to get to a place that they think they want to be.
Tom Keene with a series of brilliant interviews over the last 24 hours and another series of interviews still to come. That was John Lipsky, the former first Deputy Managing Director at the IMF, sitting down with Tom about an hour or so ago. Your equity market shaping up as follows going into the CPI print an hour and 12 minutes from now. Equity futures up by 0.7% on the S&P. Yields going kind of nowhere on a 10-year. We're down about a basis point, 388.42. Tom Keene, we've got the countdown clock ready. Inflation 1 hour and 12 minutes away.
Everybody here in Washington, John, will be looking for that U.S. CPI report. And as Lisa mentions, the core statistic, I'll be looking at Cleveland CPI or the Dallas Tribune, some of these custom indicators. But what they all mean and what we'll see at 8:30 is tension for the global financial system. If you're a geek on this, if you're part of Global Wall Street and want to dig deeper, this is the interview of the day. Tobias Adrian had the privilege of a PhD at MIT with Olivier Blanchard and the giant Stephen Ross. He is Director of Monetary Affairs and Capital Markets at the IMF. Let me cut right to it. You're the most popular guy at these meetings. What are you telling scared politicians? What are you telling scared central bankers?
Well, the number one goal for monetary policy is to get inflation back to target. In the vast majority of countries, inflation is well above target, and that is the primary concern.
Well, continue, please.
Having said that, financial stability is also at risk. So when we are looking at sort of like where we are over time in terms of financial stability, it is very concerning.
Over time, what will shift out of these meetings to over time? Will we have a more patient Jerome Powell?
Well, that's a good question. I would expect that what is priced in at the moment is what we are very comfortable with. And I do not see major changes there relative to what is priced in and relative to what was announced by the policymakers.
That thud you heard 4 days ago was me showing John Ferro in New York, British gilts out 7 standard deviations, price down, yield up. Yesterday, I believe, John will correct me, over 5%. Should we expect more 4, 5, 6, 7 standard deviation moves in fixed income?
Well, I think the Bank of England has had these targeted and temporary asset purchases that are scheduled to expire, and those have been successful in terms of bringing yields down temporarily and bringing them back up in a more gradual manner. Of course, the overall stance of monetary policy continues to be one of a tightening as inflation is above 10% in the UK.
I want you to go into your iconic green book on financial stability, or frankly instability. It is absolutely definitive in academics. What's a single chart our audience needs to know about?
Figure number 2. Figure number 2 shows the macro financial downside risk at the moment. And when you look at that chart, it's only in acute crisis that downside risk has been more elevated in the past 20 years.
What does that mean for Jerome Powell? Is he central banker to the world then?
Well, I'm very much in favor of the kind of policies that have been announced by the Federal Reserve, and we think this is the right path going forward.
But if they move 75 basis points, whatever, it's clearly nonlinear as we move to neutrality and restriction. Not to go back to Greenspanian measured approach, but are we going to see a more measured major central bank, not only us, but England and particularly ECB? Are they going to be more measured because they're told to be more measured by the
My
markets?
expectation is that they will want to see inflation coming down back towards target. At that point, it's going to be time to be more measured.
It's time now, folks, to get Tobias Adrian in trouble. Let's do that. Olivier Blanchard had the courage in these buildings to say we need to consider a 4% run rate on inflation. Adam Posen at the Peterson Institute says, well, maybe not 4%, but 3%. Is the end outcome 10 years from now or 15 years from now, we reset from 2% out to some form of inflation of 2.4, 2.8, or dare I say Posen's 3%?
The debate about the higher inflation target was at a time when inflation was too low. We were in a deflationary environment, And the argument was to raise the inflation target in order to be further away from deflation. At the moment, we have the opposite problem. We have too high inflation. So changing the inflation target when you're further away from the target, that would undermine credibility. So this is not the right time to change the inflation target to a higher level.
It's not right. It's not. What would be the catalyst to change the inflation rate?
It's if we're back down in a deflationary environment.
Okay. One final question. I know you've got 3 Bloombergs. The lights dim here in Washington when Tobias logs on to his Bloomberg. You look at foreign exchange. How do you use foreign exchange? And what are the signals of, say, yen 150, euro 0.90, or EMs giving way as well? What is that foreign exchange depreciation versus the dollar signal for your world of instability?
Absolutely. So financial conditions are tightening, and they're tightening relatively faster in the United States than in other countries. That is one of the major drivers for these exchange rates.
You have 40 meetings this week?
I have 40 bilaterals and 10 speaking engagements.
The only one that I've ever known who's had more bilats than you is John Ferro. Tobias Adrian, thank you so much. Director of Monetary and Capital Markets here at the International Monetary Fund. John, could you see you or me in 40 meetings in 3 days?
I don't think so. I don't think so. Not the morning after the long nights that you and I have had sometimes, Tom. Me propping TK up.
That would never happen.
Literally.
Yeah. Tom, thank you, sir. Over at the IMF down in Washington, D.C. What a tough moment for them. Not the moment to start talking about 3%. The question that Adam Posen is raising about next year is whether you get to next year and then they start talking about it.
Well, especially because, I mean, as Tobias Adrian was speaking, I was reading this Oxford Economics report and listening, don't worry, where they were talking about how the increasing risk of financial stability will cause an early phase out of quantitative tightening. And how much are we going to start to hear about this, which will necessitate a higher inflation rate for longer, because this does really create a problem or a ceiling for how much they can fight inflation.
It has been the real yield question of the week for the last 2 weeks. Will this Fed still be doing QT in 2023?
Can they afford to, or will something break? And if something breaks, can they afford to respond by ending quantitative tightening faster than they have laid out? It's just watching paint dry right now, John.
Yeah, they hope. They wish. Right.
Oh, you're not buying that?
I don't buy that at all. That's what they want it to be.
Totally boring.
The market doesn't see it that way.
No, they don't. And
I know that some people do, but ultimately, on net, market participants don't see it that way at all.
Okay, and this is the reason why, and Tom, yes, I am talking to you, but this is the reason why I care about the auctions, because this is where we're not seeing the marginal buyer come back in, and that does have to do with quantitative tightening around the world. If there starts to be some sort of ballast, well, suddenly then do you get a ballast for risk pricing more broadly?
Do you think you're converting him?
No.
I don't either.
He's sleeping. There's no way he's interested.
Carl Riccadano's coming up from BNP Paribas.
He's interested.
He's very interested. He'll be joining us in about 5 minutes' time with 64 minutes to go until CPI in America. Where's the clock for it? Do we actually have a clock? I don't think we have a clock.
I feel like this should be the Jeopardy soundtrack.
That sounds like elevator music.
Well, it is.
Two hours away from the opening bell. The shape of that opening will be dictated by what happens in the next 60 minutes. And 60 minutes at CPI in America. Equity futures going into that look like this. We're positive 0.6% on the S&P. We're up 1/3% on the Nasdaq 100. 6-day losing streak. You know that stat well. Coming into Thursday. In the bond market, highs of the year on a 2-year earlier this week. The high of the year just short of 435. 434.97 is your high of the year. The same week we had the lows of the year in the equity market. I think you can add up why. 428 is where we are on a 2-year right now. Yields in a couple of basis points on a 10-year maturity to 387.81. On a 30-year, down about a basis point to 386. When you look at the 30-year right now, it's not the Treasury market we're interested in. It's the gilt market. It's the UK. Allow me to frame this as a high-stakes blinking contest between fiscal authorities, the government, and the governor of the Bank of England. The governor is saying you've got 3 days. Well, you now have about 1.5 in the UK before their gilt market operation ends. And Lisa, the government is saying we're not ready to do a U-turn on our tax policy. So who blinks first if anyone blinks going into the end of this month?
And how much can this market take, right? I mean, how fragile is it? This is another issue that I don't really have a conclusive answer to. Have you gotten a clear answer to just how far some of these pension plan funds have really unwound their leverage? I don't have a sense of where we are in terms of the financial stability threat if the Bank of England does go through with this and says, we're not supporting you anymore.
I've heard from people that have told me that it's started to show up in US credit in a more pronounced way, that it perhaps explains what's happened in IG that hasn't happened elsewhere.
What you've seen is a disproportionate sell-off in top-rated investment-grade corporate bonds relative to high yield, which does not make sense heading into a financial downturn, as so many people predict, because typically it would be the more leveraged companies that would suffer more greatly. And yet, if you have UK pensions that are selling top-rated credit because they get the most money back for it, liquidate what you can, not what you want to. Is that what we're seeing ripple into the US markets?
I go back to something I said earlier this morning. You know, we can talk a lot about the UK government, whether they've made mistakes or not, and many people think they have. But did you think that £45 billion worth of tax cuts would trigger this kind of reaction, not just in the gilt market, but in global markets, the spillover from that to elsewhere? That surprised me too.
And this is the reason why financial stability, not in the United Kingdom, but globally, is now the main concern for so many people. What does it say about the fragility of the state that we're in if that's all it took to trigger such a massive ripple effect?
What's more interesting here, what they did or how the market responded to it?
Definitely with how the market responded to it.
Right, and do you think the Bank of England's been shocked by that too? I'd suggest they have been.
Which raises questions about quantitative tightening more broadly and what kind of ability central bankers have to keep going despite the rising fragility of many markets.
We should write a paper on this.
I think so.
It would be great.
Next break.
We can do that in Tom's next interview. Just make notes. Sonali Basak is down in DC as well. She's at the IIF, not the IMF. She's our Wall Street correspondent. Sonali, BlackRock out a little bit early this morning. You and I are going to have some long conversations tomorrow morning when the big banks come out. Give me a read on BlackRock. What does it mean for the big guys on Wall Street?
It's a great question because this is the moment of truth. How could a $10 trillion asset manager fare in the face of the storm? And the answer is assets have declined meaningfully this year. They're back below $8 trillion. It's the lowest level since 2020, John. Now, when you look at earnings per share, they have beat analyst estimates. However, you're seeing those long-term flows all year under pressure. I think it's important to see where exactly did flows turn negative. You're looking at negative flows in the retail clients, and then you're also seeing them in the institutional clients when it comes to index funds. This is at the end of this, the third quarter. The question is, how much has this continued since then to that pressure that Lisa has been talking about that a lot of institutional clients have felt and therefore have sold more liquid products first? You have Larry Fink in the statement really talking to the idea that there are flows in fixed income that are very, very strong still and that there are flows into alternatives. I looked at the alternatives business. There is still pressure there when it comes to currencies and commodities. And again, this is at the end of the third quarter. So the question remains, how much more pain did they feel from there?
Sonali, this is definitely a bellwether company, considering its scope as an asset manager. Is there any sense that people are rethinking their commitment to index funds in the face of dramatic underperformance, particularly by big tech, which are some of the main components here?
That's a great question because this is an existential question for the big passive funds that have seen such a long bull market. And BlackRock, of course, is the king of this world. So that passive fund question is not only a question about whether what this means for market structure, market liquidity, but there's also a lot of questions about this business model in terms of the more liquid things you have to sell, you will sell first. That is stuff that you have in ETFs, for example. But again, the fixed income flows are interesting. Will Larry Fink be discussing more of a pivotal business shift as the world changes into QT and into a tougher macroeconomic environment, at least in the nearer term, maybe longer term? He is speaking, Larry Fink is speaking here at the IIF today at in the 5 p.m. hour. I will be listening. He will be addressing that macroeconomic outlook here.
Sonali, you and I are going to catch up again in about 2 hours' time, just around the opening bell. Looking forward to doing that. Sonali Basak there, down in Washington, D.C. They built a phenomenal business to surf the wave that dominated the last 10 years. That wave's starting to break. one, and two, to see him in the political crosshairs in the way that he has been, I'm speaking about Larry Fink, is fascinating as well at the moment.
Especially with ESG, environmental, social, and governance, and you have a number of states withdrawing cash from BlackRock, and you have a number of businesses not wanting to do business with them. It raises issues about being, a sort of a stakeholder rather than a shareholder, and some of the recent move in corporate America away from the Milton Friedman kind of model and how far they can go with that.
Fink sounded like a journalist recently. I think he said in the last 24 hours something like, the left are annoyed with me, the right are annoyed with me. I hope I'm doing something right.
Well, it's, we can talk more about this. Nonetheless, it is a political concern at a time when there is this business consideration about the shift, and riding a bull market is a good way of putting it.
And Carl Riccadonna joins us now, chief US economist at BNP Paribas. We are within 60 minutes away from CPI in America. Carl, let's just start here. The inflation print. What are you and the team at BNP looking for?
Well, I think looking at this morning's report, there's a few things we do know. We know that rents are sticky and running hot. We know that core service inflation is also sticky and running hot. So the real question is this issue of supply chain healing, and if that starts to materialize in lower core goods inflation. I think there's a compelling case if we look at the cost of shipping a container across the Pacific. It's down about 75% from the peak. A ripping dollar up about 16% year on year in the Bloomberg Dollar Index should be translating into declining import prices. We haven't seen that yet. There's a big inventory liquidation story. So there's a lot of elements to this supply chain healing story that make a compelling case for lower goods inflation going forward. There's not a compelling case that this happens in the month of September. So we'll be kind of watching around the margins for any clues that that's coming. Yesterday's PPI was not particularly encouraging. But this is kind of a key focal point going forward.
So how do you communicate this to clients? Because they've been burned by faith-based inflation reads for a long time, saying it's a backward-looking indicator and it's going to soften going forward. How do you communicate to them if you look at the chip sector, if you look at the retail sector, if you look at certain healing supply chains, you do see this year-over-year comp that's going to bring down inflation, but maybe this print, you can ignore this one too?
Well, I think whether we're talking about the Fed or private forecasters, there's much less certainty around the dynamics at the moment, as a lot of forecasters have been burned over the course of the last year, from team transitory onto other more moderate types of forecasters as well. And I think what we have to do is acknowledge what has occurred and the fact that we are starting to come off of the boil. So consumer prices will probably be the last shoe to drop as we see an inflection and some moderation on the inflation numbers. We can see in the PPI we're off of the peaks. Certainly as we look at inflation expectations numbers, whether it's from the New York Fed or the University of Michigan, they are off of the peaks as well. If we look at prices paid in the ISM survey, off the peak. So we can see a lot of kind of upstream signals that inflation is at least topping out. We certainly haven't seen the realized improvement just yet, but there's a compelling case to be made looking at historical relationships for some degree of improvement. Now, what's going to be difficult, the supply chain story only gets us so far. So the San Francisco Federal Reserve did some work showing about 40 to 50% of inflation at the moment is supply chain related. That doesn't get us back to 2%. What gets us back to 2% is a firm foot on the brake pedal from the Federal Reserve, meaning not only do we go into restrictive territory, but we hold that restrictive stance of monetary policy for an extended period, which in my own view, our team view here at BNP, is that this could stretch out over a 2-year horizon even.
Hey, Carl, we've got to leave it there. Just a bit of news on the other side of the pond. Carl Riccadonna, thank you, sir. We are reporting here at Bloomberg the UK officials are working on a U-turn for parts of Truss's tax cut plan. We also understand the same thing from Sky News moments ago in the UK, that talks are underway over whether to reverse parts of the mini budget. So these reports are coming from left, right and centre. You can see the price reaction to this. Lisa and I only minutes ago were talking about the prospect of a U-turn. Where would it come from? From the central bank or from the government? Off the back of this reporting, sterling is a whole lot stronger. Cable 112.54, up by 1.4% on that currency pair. The low of the session was 110.58. So that gives you an idea of the range this morning. The high was just a moment ago at 112.61. We already had a rally in the gilt market, I can tell you that rally is a whole lot bigger now. The 10-year gilt yield is down by 37 basis points to just north of 4%. The 30-year gilt, which has become a big focus for this market, is down by 42 basis points to 4.38. Now, we talked about the blinking contest. Lisa, is someone about to blink down on number 10 Downing Street?
It seems like Truss is about to blink first. And here's the issue. If she doesn't, if they come out and they say, just kidding, we're not going to do this, then what happens? I mean, honestly, the violent reaction shows what markets think of her proposal to cut taxes and boost spending in an unlimited fashion.
So Governor Bailey was criticised, heavily so, for reaffirming the deadline for his gilt operation, which is tomorrow. If they U-turn at number 10 Downing Street, does the villain start to look like a bit of a hero?
Yeah, and over to you, Governor. Just kidding. We're going to actually focus on doing something else, so, don't mind us.
Let's see if this transpires. Once again, nothing confirmed. Our reporting suggesting that officials in the UK are working on a U-turn for Truss's tax cut plan. Remains to be seen whether that U-turn actually materialises. We'll keep an eye on that. We'll keep another eye on inflation. 50 minutes away. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Ukraine, the Kyiv region was struck by Iranian-made drones this morning as air raid sirens rang out across much of the country for a fourth morning. Airstrikes also continued in the south. Meanwhile, allies in Brussels for a NATO defense ministers meeting are expected to offer more air defense capabilities for Ukraine in face of Russia's stepped-up missile strikes. The International Energy Agency says OPEC's decision to sharply curtail oil production threatens to push prices to levels that tip the global economy into recession. The head of the IEA Oil Market Division spoke to Bloomberg.
We're not calling on OPEC we're not setting their policy. Obviously, this is for the OPEC to decide. What we're saying is that by cutting supplies to the market, it's preventing a rebuilding of inventories that are still critically low.
Demand is now expected to contract by 340,000 barrels a day in the fourth quarter. North Korea's state media says leader Kim Jong-un has supervised tests of long-range cruise missiles in recent days. Kim says the missiles are intended for tactical nuclear strikes, while warning Washington that any attempted attack could be met by strikes at American forces in South Korea and Japan. The comments are a fresh sign that North Korea could be preparing for its first nuclear test since September 2017. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The number one goal for monetary policy is to get inflation back to target. In the vast majority of countries, inflation is well above target, and that is the primary concern. Having said that, financial stability is also at risk. So when we are looking at sort of like where we are over time in terms of financial stability, it is very concerning.
Tobias Adrian there of the IMF sitting down with Tom Keene just moments ago. Breaking news here at Bloomberg in the last 10 minutes or so, led by Kitty Donaldson out of London. Here's the lead paragraph for you. According to a person familiar with the conversations, UK officials at number 10 and the Treasury are discussing how they can back down from the Prime Minister's plans for a massive unfunded package of tax cuts. The reaction in the market, pretty simple. Sterling stronger, yields lower. Let's take a snapshot of things for you. Cable off to the races off the back of that headline. The pound a whole lot stronger off the back of this. 110, the low of the session. 112.45 is where we trade right now. Gilt yields lower off the back of this as well, Bramo. Down 34 basis points off the lows of the session, initially off the back of these news, but still lower and lower aggressively so to 4.47, call it 4.48. All going into tomorrow, where the Governor of the Bank of England says it's over. The gilt market operation finishes.
And can we say that the Truss administration blinked? Is this enough? The idea that they're even considering going back on the plans that she said, despite some of the hard language that they've heard. The fact that that triggers this kind of response shows how tenuous people feel right now about the budget of the United Kingdom.
Let's see if the U-turn materialises. One, this is a suggestion they're having conversations about it. And two, if there is some form of U-turn, what do they back down on? And what don't they back down on? And is that enough to satisfy some of the concerns in this market.
Especially because, as you pointed out, a $45 billion tax cut. Is that enough to trigger the turmoil that we have seen? Is that justification for the degree of upset, or is this something else as well?
Well, I've said what's more interesting here, what they announced or how this market responded to it. And I think we can all conclude this is a very fragile market right now. We'll catch up with Guy Johnson in about 10 minutes' time. Guy described this market as febrile. He said this is probably not the best idea when your backdrop is febrile markets, and I'm sure most people would agree. Gilt yield to lower by 34 basis points. TK, big moves in the UK, and a lot to talk about down in DC.
And on to 40 minutes from now, the inflation report in the United States. Everyone here from the IIF, John, the World Bank, and the International Monetary Fund riveted on that 8:30 statistic. Right now, he is the president of the World Bank. Of course, David Malpass joins us. I need to clear something up off of a Politico article, and this is the uproar about senators and your tenure at the World Bank, where something was said, you're not a scientist. I fell off my chair because you are the physics major from Colorado College. Always. Clarify right now your position with the World Bank, given this turf war, this political war in Washington.
So it's very clear that people cause greenhouse gas emissions, and that affects climate change. And so that should have been clear in the original remarks, and whether you're a scientist or not doesn't matter. And so it got off track. I think we're back on track because what the World Bank is doing is a massive amount with regard to climate change, both in countries that need adaptation, living with the changes going on, and with the mitigation. So there's this intense focus within the World Bank on these efforts.
And what's great about this, folks, and this goes back decades and decades, one of the coolest science majors in America was at Colorado College. The way they taught science at CC was so different back when Malpass was there in physics. Let's go to the equation. S equals VOT plus 1/2 GT squared. There's the gravitational constant in there. Nassim Taleb, the derivative giant, says that G matters right now. What does the new gravity of higher yields and inflation mean for the debt buildup that the World Bank confronts?
Within physics, the gravity is always there. Within economics, there was this temporary period where interest rates could be at zero, and there were various explanations of why that was working. Now it's back to where there is a connection between interest rates and inflation. So the central banks are moving up toward some kind of neutral, where it's non-inflationary. Fiscal policy is also changing massively. One of the themes of this week for the advanced economies is how do you mesh those two policies, the fiscal and monetary policy, so they don't conflict with each other. So if that means you're tightening on one side, do you want to tighten on another side?
But what does it mean for the World Bank and the billions of people in the world at heel to the Bank of England and to the Fed?
This is a really challenging, and I call it a crisis-facing development. People living in developing countries aren't getting capital. In fact, there's a capital outflow. They're seeing their currencies weaken, and a lot of their debt is in dollar terms. So as their currency weakens, the burden of the debt goes up, and interest rates are going up. So that's really a trifecta, a triple burden going on to the countries. And many of them had built up debt under COVID, because that was the cyclical, the counter-cyclical response. So there's been a lot of talk the last couple days about ways to have a better debt restructuring process for the countries that hit the wall.
Somehow seen through currency, from Mundell to Jacob Frankel and on, we've studied foreign exchange on this. But the modern equivalent is in the derivative space and in the immediacy of overnight swap lines. This goes back to your Bear Stearns tenure. Do you feel we have a stronger structure now with swap agreements with the rich guys, the Fed, to allow the World Bank community to have liquidity in these distorted times?
So developing countries have a challenge in finding swap lines. Some do with the IMF or with the U.S. Fed, but for the poorer countries in general, they don't. They may be able to arrange something, but when that happens, that means you're under the gun. So a better way to do it is to find a way to get to actual debt reduction so that you have light at the end of the tunnel, get out from under the debt. So that applies to the to the lower income countries. You know, we're up to where there are dozens and dozens that are where the debt is unsustainable, and that means you need to have some solution to go through it. That's under discussion.
Challenging times, to say the least. David Malpass, thank you so much for joining Bloomberg
Tom.
today. He is, of course, with the World Bank. John Ferro?
Hey, Tom, send our best to President Malpass. Great interview, great conversation as always, and looking forward to your chat with the IMF Managing Director in the next hour or so. Lisa, did you ever think that a UK budget could send equity futures to session highs, up around about 1% on the S&P 500. The prospect of a U-turn, I say the prospect, our latest reporting suggesting the conversation is underway to discuss having that U-turn on certain parts of the budget. Lisa, for all those that have thrown derogatory terms at the UK as being an emerging market, a small country, insignificant, I tell you what, that insignificant small emerging market seems to be shaking markets up a lot.
In a significant way and throughout a number of different asset classes. I pose this to you. What happens then if you get some sort of yield curve control that is abandoned over in Japan? A more significant market, arguably.
You're on to the next crisis already.
100%. Well, I'm looking for the next potential node of contagion.
Can we deal with this one first?
Okay, fine. Yes, but yes, this one it's amazing, the contagion. It's true.
Well, let's see if they actually back away from big parts of this tax plan first.
The point about the fragility of the market, that was the point that I was making. And this crisis is not over.
We're on the same page. They're repricing the BOE now, aren't they?
Yeah, exactly. Now it's less than 100 basis points of a rate hike in November.
Like that.
Just like that. Don't have to
Let's see if we actually get any news on this. So far, that's the latest reports. Let's see what they actually do. But the price action speaks for itself. CPI in the next hour.
We keep looking for this Fed pivot. Let's fight the inflation first and then worry about that.
I believe that inflation's a little more stickier than what's being forecasted.
We still have policy that is not yet tight.
The Fed, if they acted earlier, they could have stopped earlier, and instead inflation got out of control.
I do think the Fed will start decelerating here. Do think all the inflation lead indicators are falling.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is CPI Thursday, and that number drops in 30 minutes' time. Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio right here in New York City with Lisa Abramowicz. I'm Jonathan Ferro. Bramo, futures positive, 1%.
Can we blame or can we attribute the gains right now to the United Kingdom and the possibility of some sort of U-turn by the Truss administration on unfunded tax cuts?
You can blame them or thank them, depending on what side of the market you're on.
I suppose.
But take your pick, sure.
And that really raises some serious issues because if, as you were saying, it is this one market that is dictating the moves, how fragile are markets right now? And how much can that change in a dime? How much do we not necessarily see real volumes with real conviction heading into a CPI print that could dictate the path, at least the near-term path for the Federal Reserve?
A couple of headlines in the last 30 minutes' time. We're reporting here at Bloomberg that the Truss administration, the Truss government, is having a conversation about some form of U-turn, a conversation. It hasn't materialised yet. They're talking about it. What aspects of it will they back away from? The Sun, the newspaper in the United Kingdom this morning, reporting the following, that Liz Truss is considering raising corporation tax next year. So that's one element of the tax cuts they might be backing away from.
Let's talk about what they're funding now. It is a no cap kind of spending package to try to bring down the costs for individuals who are facing heating bills. Well, this goes back to policy, right? I mean, how do they then crimp demand? How do they then create something that doesn't just become a self-fulfilling prophecy? When people dig into the details, is it still a real sigh of relief? Or what we're seeing in the United Kingdom just highlighting what we're seeing more broadly with costs of financing rising and a lot of nations having a lot harder time dealing with it?
Is Governor Bailey a hero or a villain?
Right now, well, who is he talking to?
Precisely.
3 days. Get
3
it done.
days. Who is it for?
Who's it for?
Guy Johnson's got thoughts on that. Guy's going to join us in just a moment. I want to run through the market action for you. On the S&P 500, up by around about 1%. The CPI number drops in about 28 minutes' time. The bond market bid yield to lower by 3 basis points on a US 10-year. On a UK 10-year, we are a whole lot lower than that. We'll pick up on that story in a moment. Euro dollar, euro stronger too. 97.41 on euro dollar, stronger by about 0.4%. Out of London, Guy Johnson joins us right now. Guy, your thoughts on what we're hearing in the last 20 minutes?
So we've all been wondering who's going to blink first. I think we now know the answer. I think probably there is an argument to say that Governor Bailey was talking to the government when he said, you've got 3 days to sort this out. He may have been talking to the market as well, but it certainly seems as if that threat has resonated in number 10 and number 11 Downing Street. The market is moving on rumours at the moment. As you say, we still don't know the details of exactly what is going to be reversed, which aspects of the unfunded tax policy that we're going to be seeing changed. I think the Sun report is very, very interesting. John, the market has been all over the place this morning. We initially saw a big move lower in yields. And you do wonder whether or not that is predicated on the idea that we are seeing the Bank of England's policies and the help it's being provided having an effect, or rumours have been swirling about a U-turn. Kitty Donaldson and the team confirming that now, that there is a conversation happening about a U-turn, and you've seen the market response off that. This is what the market was primed for. It was waiting for the government to blink. And it looks like we're getting close to the government blinking.
How much does the government have to blink because of conservative pushback, a pushback from Liz Truss's own administration to say this is infeasible and could potentially undermine any potential growth in the UK for years to come?
I think it's coming from a number of different areas. Clearly, within the Conservative Party, there is much annoyance about the way that this has been handled. Her authority has been diminished also almost from the get-go, Lisa. But it's coming from the markets. It's coming from Conservative Party donors. It's coming from a whole host of sources at the moment. And the force of that is now clearly too much for the government to bear. And as a result of which, we are going to have yet another U-turn. I'm not even sure which way we're facing at the moment. I think we'll probably maybe find out at the end of the day.
I'm not sure market participants are sure either. Guy, thank you. Guy Johnson out of London. Gilt yields lower on a 30-year by 31 basis points, 4.49 on a UK 30-year. Lucky, happy to say that joining us around the table is David Kelly, the Chief Global Strategist at JP Morgan Asset Management. David, we'll talk about CPI in a moment. Can you tell me what's more surprising to you? What was announced by the UK a couple of weeks ago, or just how the market has responded to it? Just the idea that we've had this much volatility off the announcement of, what, 45 billion sterling of tax cuts?
Well, think about it. We have sort of seen a regime change. I mean, for years, we've had a central bank safety blanket, which has really protected markets from anything that might be going on from the political side. And now that has evaporated, and so the bond market vigilantes are back. These happen to be British bond market vigilantes, but it's basically the same situation that we saw back in the 1990s, where central banks weren't necessarily going to help the government out. I think we're seeing that in the UK. To some extent, I think we're seeing that in the United States also.
Well, maybe, right? And we're getting more calls that quantitative tightening will be phased out basically a minute after it was introduced, because central banks will have to come in and really back up some of these spending plans. From your vantage point, how much can you trust that versus bet on yields going even higher from here, whether it's the US or the UK?
I don't expect yields to go much higher from here, because I really think we have turned the corner on inflation. I think there's, we're not talking, nobody is saying that really inflation is going higher. We're simply talking about the slope of the slide in inflation. And I think, whatever number we get today, I believe that CPI inflation might be 8% year over year. Today, 8.1. By December, it's going to be 7%. It is coming down. And because inflation is going to come down, I believe that means we should be close to a top on yields.
Although, even if it's coming down, 7% is not going to be very comforting. Neither will 6%. And possibly not even 5%, even if it comes down pretty quickly, if it stays, if it starts to decelerate in terms of how quickly it comes down. And if core inflation continues to accelerate even in the month of September.
Well, first of all, the historical record is that if you look at inflation, inflation goes up and comes down. It looks like the Eiffel Tower. And whenever we've seen this in the past, unlike unemployment, which looks like a playground slide, it sort of goes up and then comes down slowly. But inflation tends to come down quickly. And the only part that's really sticky here is shelter. And that's owner's equivalent rent, which nobody pays. So the part that's sticky doesn't matter. And so I really don't think that I think we're just too obsessed with inflation because we haven't seen this beast in 40 years and we're just all a little too excited about it. And it's just not that threatening and not worth putting the US economy into recession over.
Well, that's what the Fed is doing, isn't it? 300 basis points worth of tightening in 6 months? Isn't that the risk it's taking?
I think they're overreacting to it. I mean, I don't mind the Fed getting back to normal. I think they ought to. But they said they wanted to not add to uncertainty. They're adding to uncertainty. So what they should do is say, look, this is what we're doing and we're trying to get back to normal, but then we're going to stop. because we don't want to kill the economy for an inflation battle that we're going to win anyway.
You know better than most that getting into the debate about what they should and shouldn't do, ultimately we can do this for hours. Lisa loves it. It's a sport. I love it too.
Play it all the time.
What they will and won't do is what matters ultimately to this market. Can you tell me what you think is going to happen here, given what they're set to do
I think
through the next 6 months?
I think they're still very sort of self-conscious about this. So I think they will go 75 in November, they will go 50 in December, probably go 25 at the start of February. But then I think they'll stop. And I do think that within the next year, we will see a Fed pivot of sorts, because at some stage they've got to find themselves an off-ramp from this. They want to sound hawkish, but they know. I mean, a lot of economists are saying what I'm saying. I'm startled by how many economists are seeing this, exactly the same thing. With inflation is coming down, they don't need to put the economy in recession to kill it.
So this sounds like you are getting long, or you already are long, some of the longer-dated bonds, particularly in the U.S. Is it positive for risk assets if they start to decelerate the pace of rate hikes into year-end and into the early 2023?
Yeah, I think so. But I think the setup is positive for risk assets because, frankly, everything's on sale. I mean, we're down 25% on equities from a year ago, and so things are on sale. And I think what's going to happen here, we've got a lot of uncertainty right now, but at the end of this, we're going to emerge with a very slow-growing economy with low inflation. The Fed's going to have to put in low interest rates because fiscal policies are going to be stimulative. And so you're going to have low growth, low inflation, low interest rates, probably decent profit margins. And that's actually a pretty good environment for financial assets, both stocks and bonds.
Are you saying pull out the pre-pandemic playbook and...
Yes, I think it's back to the future. We're going to end up, because of the Fed overdoing this, we're going to end up back where we were 10 years ago.
So this is not some big structural shift. This is just an aberration. The last 2 years or so.
Correct. If it was a structural shift, you'd see the unions back. The unions aren't back. 10% of America is unionized. It's over 25% in the 1970s. You'd have different markets which weren't sort of instantaneous. Would have a lot of we wouldn't have internet technology allowing you buying anything you wanted at any price immediately.
So is this going to be another bond bull market?
Well, it's not that, a bit of a bond bull market, but we're only going down from, if we go from 4 to 2, that's, you can make some money there, but it's not like the great bond market, bull market from the 1980s.
This is the constructive view on things.
Yeah, well, basically...
The old playbook, the old regime.
And he's not alone, right?
Oh, no.
I mean, there are a lot of people who think that we're going to go to an even lower terminal rate post-pandemic after this blip, simply because of the amount of hangover and the slower growth that you're going to end up getting because of some of what we're hearing from the Fed right now.
Given how wrong we've been about 20 different things over the last couple of years, I'm doing my best to stay open-minded about the whole thing. I've got no idea.
Open. Yeah, I have no idea.
No idea. David Kelly, thank you, sir.
Anytime.
I'm not saying you should be open-minded, just saying,
well,
it wasn't personal, David.
Well, no, I mean, but I think that you have to be open-minded because
these cycles move so quickly.
So my father's a mathematician, and he used to say to me, you look at all these equations, but you never know the parameters, and you always get the parameters wrong.
Yeah.
And right now, no one knows what the parameters are, and so you're making assumptions based on whether we're going back to the normal of 10 years ago or 5 years ago, or we're going back to the normal of 20 or 30 years ago.
Will he do a phone interview in 20 minutes' time?
Oh, please. He's in Italy right now. He's doing great.
He has no interest breaking down inflation in America.
He can talk about the euro and how happy he is about it right now.
Coming up, Jeremy Stretch. Does he need a research assistant?
Yeah.
I'd love to join. Jeremy Stretch is going to join us from CIBC in just a moment. Inflation 19 minutes away, live from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Pfizer and its German COVID vaccine partners say their booster shot, tailored to the latest Omicron variants, appears to offer better protection than the original against currently dominant versions of the virus. The latest data is the first evidence that the vaccine does provide better protection compared with earlier shots that were based on the original strain of the virus. China is defending its controversial and costly COVID-0 policy for the fourth day in a row, this time through one of the country's top virus officials. A National Health Commission expert saying at a briefing today that it's inevitable the curbs the country uses to control transmission have impacted the economy. The comments come just days before President Xi Jinping is expected to secure a precedent-breaking third term in power. Meanwhile, in Beijing, about 24 police patrolled a busy intersection after photos and videos circulated of a rare protest attacking President Xi Jinping just days before that crucial Communist Party meeting. At least a half dozen photos and videos on social media showed two unfurled banners across the bridge in northwestern Beijing. They took aim directly at Xi, criticizing his restrictive COVID-19 policies of lockdowns and mass testing. Heavy rain in southeast Australia is forcing hundreds to evacuate their homes. Thousands more are without power. Rivers across Australia's most populous states have reached dangerous levels after months of above-average rainfall. Around 250 homes west of Sydney were ordered to evacuate ahead of major flooding. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Pushing inflation down below a certain level by lowering wage inflation, pushing unemployment up, is going to become increasingly difficult for the Fed to stick to that policies, especially when you're having all these problems in other parts of the world. So the pressure is going to mount on the Fed.
Andrew Sliman of Morgan Stanley Investment Management. We are 12 minutes away from CPI in America. Going into that number, your market shaping up as follows on the S&P 500 into Thursday. 6-day losing streak right now. Futures positive, 39 points, up by 1.1%. Yields are lower by 3 or 4 basis points to 385.98. This headline just out of Germany, the Bundesbank. For those of you that missed this, German 23 inflation, so inflation next year, likely to be between 7% and 8%. Lisa, that is next year. Not the end of the month, not the end of this year. They're still looking at a 7 handle and 8 handle in Germany next year.
And where was it 6 months ago? I mean, this is the other aspect of this.
Sure.
It was way, way, way down from that. And so how much and how quickly are things developing? They're also downgrading their growth forecasts pretty dramatically because this is the stagflationary fear that so many people had, and Germany is in the crosshairs.
It's materialising. Let's get the view from Jeremy Stretch, the head of G10 FX strategy at CIBC. Jeremy, in about 11 minutes now, I'll keep counting us down. CPI just around the corner. What are you and the team looking for?
Well, I think after the PPI release yesterday, I think there is definitely a definitive fear that we could see a slight nudge to the top side, particularly in terms of core prices. So I think that could be a function which will provide a little bit of residual support for the dollar and really maintain that narrative of another 75 beep of policy tightening coming in the next FOMC.
Jeremy, you noted that this is a big short squeeze on the pound and that you're seeing these whipsaw movements because people are leveraged and getting in and positioned very much in a loosely traded market right now. There isn't conviction in terms of where people are going. How much is that becoming a theme? Is going to create that much more volatility going forward, even if these reports are confirmed with details?
Yes, that's right. We are seeing a definitive short squeeze over the course of the last couple of hours or so, and that's really a function of incredible degrees of speculation here in the UK that could either be a fiscal U-turn of some form being discussed by the Prime Minister, Liz Truss, whilst, of course, notably the Chancellor and the Finance Minister is in Washington, meeting with the IMF today. And also at the same time, there's increasing speculation that the Prime Minister's own tenure, which is only 37 days old, could also be under extreme threat. So that is creating this short squeeze. It's creating a significant degree of rebound or rally in the gilts market. But there is a lack of conviction because, of course, all of these reports are consistently either denied or often rubbish. So there is a great deal of volatility. And that really makes it very difficult to hold any positions with any conviction for any length of time.
Looking at these moves in stocks on the FTSE 100 as well. Barclays this morning rallying. Lloyds Banking is up by 6.3%. Barclays up by 4.8%. Can you tell me, Jeremy, if they are discussing this, and we're reporting that they are discussing a U-turn, what we don't know is whether they deliver on that U-turn. What are the elements of the tax package that would need to be backed away from that would convince you enough to come into this market again and say, let's buy sterling? The policy setting on either side, monetary, fiscal, is a little bit more durable now. I think we can buy the pound here.
Well, the first problem is, of course, that fiscal and monetary policy appeared to be moving in completely opposite directions in the context of that fiscal event. So I think we'd need to see some degree of reduction in terms of the fiscal expansion, which was implied by those tax cuts. So it may well be the case that that reduction in the basic rate of tax could be pushed forward by a year. Now, that's not a big revenue raiser, but I think that will reduce some of the fiscal impulse from next year, and that will ease some of the burden on the Bank of England. Also interesting, there's some debate about some degree of corporation tax hike coming back into the agenda. And of course, that's very difficult when you're trying to drive for growth. So I think the government are in a really difficult spot here. But I think if there were to be any reductions in terms of that fiscal expansion, which was really driving inflation dynamics through the course of next year and making the job of the Bank of England all the more difficult, then that could create conditions which would be constructive. And of course, if Prime Minister Truss were potentially going to be removed or at least taken out of the equation, then I think you could easily see sterling getting back to maybe a 117.5 handle. So there is plenty of scope for a degree of rebound in sterling, but it is very much a function of these rumours, or at least some of this speculation, proving to have some degree of durability.
Again, let's see if there's any follow-through whatsoever, though. Jeremy, I think the question I'm trying to ask is that even if they walked it all back, went back to the very beginning where they started, didn't do any of this stuff, would you see any scarring on sterling assets? Would we have to have an additional risk premium baked in?
Yes, I think that's undoubtedly true. As we all know, that once you lose credibility in any way, shape or form, whether it be markets, whether it be relationships, it takes a long, long time to rebuild credibility and rebuild confidence. So I think the confidence in UK PLC as a major G7 trading nation has been materially undermined by the events of the course of the last 2 to 3 weeks. Official institutions have obviously been compromised, whether it be the UK Civil Service, whether it be the Office for Budget Responsibility. So I think it would take some considerable time for UK assets to move back to absolute valuation levels. And I think there will still be a degree of credibility discount being put in place in terms of UK assets over the course of the next few weeks and months, even if all of these fiscal events and the political risks are compromised from what we've seen over the course of the last 2 to 3 weeks.
Jeremy, it seems like the crisis is now over in the United Kingdom. That's tongue-in-cheek if anyone pushes back and says that's absolutely not the case. We can move on to the next crisis.
Right.
All right, so I'm looking right now at the yen, and we've been looking at it approach the weakest levels going back to 1998. It hit that yesterday. What vulnerability is there that was really exposed, thrown into relief from what happened in the United Kingdom, if there is some sort of policy shift over in Japan?
Well, clearly, we've seen the MOF intervening for the first time in obviously 25 or almost 25 years. But the underlying metric and message is that if Japanese monetary policy is still going to be very divergent from the rest of the world, then the path of least resistance is probably still dollar yen moving higher. And I think that's going to be very much the sort of the ethos that's going to remain in play during the final stages of Kuroda's tenure, because his position will come to a conclusion. His 10-year term will end at the end of Q1, and he still feels confident that, or necessary, for monetary policy stimulus to remain in play, because there is a lack of wage growth. And that's the real crux of the issue for Japan. But I think we're starting to see some of those inflationary pressures moving down the pipeline, and that's going to squeeze corporate margins, and that's going to make it even more difficult to see any sustainable wage growth in Japan. So I think it may well be the case that it's going to be the job for the next governor of the Bank of Japan to try and pick up the pieces or deal with the ramifications of this protracted and prolonged period of easy monetary policy, which inevitably is probably going to see dollar yen squeezing higher until markets are confident that probably US nominal yields have reached a peak.
What a tough task for whoever takes over. Jeremy, thank you. Jeremy Stretch there of CIBC. Looking at it from Kuroda's perspective, and I don't think we do that enough, I believe the BOJ sees this as a once-in-a-lifetime opportunity to reset inflation expectations higher. This was the ultimate goal for the last 20, 30 years of policy. Here it is, the opening for them to do it. I've sat here and said it looks like they've got their head in the sand whilst the rest of the world is hiking interest rates. I agree with you, to back away from yield curve control will be tremendously difficult. But from their perspective, they don't see these inflation numbers in Japan as a problem. They see it as an opportunity.
What happened to you? You're all open-minded, thinking of all the other
Spiritual.
sides today.
I did some yoga last night.
I mean, what is
And
this?
this morning, very zen.
I mean, what's mindful meditation that you're doing?
A lot of mindfulness.
Open-minded. We don't know
Or
anything.
maybe it's Tom's not here and I'm just a little bit more relaxed.
Think about it from his perspective.
CPI in America, up next. This is Bloomberg. Ten seconds away from inflation data in America. Going into this, equity futures just off session highs on the S&P 500, up a little more than 1%. With the data in Washington, D.C., we can cross over to Mike McKee.
Well, John, it looks like the score is inflation 1, Fed nothing today, as the CPI comes in up 0.4% on a month-over-month basis, which is higher than it was last month and higher than expected. And the core, which the Fed is following much more closely, comes in up 0.6, same as last month, and more than anticipated by the markets. This is exactly the same thing that happened last month, and we saw a big reaction in the markets. On a year-over-year basis, the headline CPI drops from 8.3 to 8.2% as base effects come into that. But for the core, it rises to 6.6% from 6.3%. So it is not a good picture here. Those who were thinking that inflation might drop off fairly quickly are going to be disappointed by the numbers here. Why don't you let us know what's happening in the markets, and I'll look at where the big movers are.
Yeah, let's do that, Mike. As you say, it's off to the races. Down and down hard on the S&P 500. We're negative by 1.5% on the S&P. When you push this through the bond market, look at the front end of the yield curve. Through 440 on a US 2-year. So that is a new high for the year and a high we have not seen since 2007, up 10 basis points on a session now at the front end of the curve. On 10s up 7 to about 397, breaching through 4% a couple of times over the last couple of weeks, but yields up and away again at the front end seems to be the theme of things right here. Lisa, the wrong kind of upside surprise and pretty much across the board here on core month on month, which is what Wall Street was looking at. The front page of the newspaper will go with the headline year over year, and let's be honest about it, that is not pretty either.
Especially at a time when people are talking about how you are seeing lower energy prices, you are seeing certain retailers start to discount items. It is not feeding through. How much the fact that we're not getting a flatter yield curve materially, so the fact that you are getting higher yields at the long end as well indicates that perhaps people are rethinking some of these inflationary inputs and how quickly they can roll over, John.
Inflation coming in hot, Mike McKee. Have you got the compositional breakdown yet, Mike? Just the detail of things. What got us here?
Yeah, it is disappointing, John, when you look at it. Of course, gasoline comes in down for the month, down 4.9%, but that wasn't enough to offset some of the big rises. Shelter, which, of course, everybody is pointing to as the big culprit for inflation these days, is up by 0.8, which is a tenth more than it has been over the past 3 months. There was hope that it might start to moderate. Owner's equivalent rent up 1%. And that's the calculation that people do, the government does for shelter. There was one decline in apparel, down 0.3. That's the inventory stuff that Lisa is talking about. Used cars were down by 1.1%. We've been waiting for a big drop there, but new cars come in up 0.7. And then the big thing that probably people were not expecting is gasoline goes down, but other energy goes up. Electricity up 0.4, and natural gas up 2.9%. So a lot of inflation contributors from areas that we weren't expecting. Some had thought that airline fares would go down. They're up 0.8, and motor vehicle insurance, which has been a problem for the Fed all along, is up 1.6%. So a lot of underlying inflation that shows no signs of backing off.
A couple of months ago, Mike, we were talking peak inflation, and perhaps people were talking about the headline number. Are we getting closer to peak inflation when it comes to the core?
Well, you have to think that it's going to happen in one of these months because the Fed has been tightening, and it should start to have an impact. But as the Fed said, with the labor market as tight as it is, companies are still probably adding employees to the extent they are at higher wages, and that means they're passing it along to consumers. Jim Bullard of the St. Louis Fed has said basically it's up to the companies. They feel they have pricing power now, so they're using it. They need to realize that they need to back off or it's going to hurt everybody.
Mike, this was never about the November meeting. The November meeting was 75 almost nailed on. It was about whether in the news conference this Fed, this chairman, could lay the groundwork for a downshift from 75 to 50 to 25. Given the data calendar from now to there, do you think it's going to be very difficult for this chairman to lay the groundwork to do just that?
It's going to be very difficult. They want to get to 4.5%, 4.5 to 4.75 by March of next year. They may be forced into doing it earlier. The sequencing was supposed to be something along the lines of 75 in November and 50 in December, but now 75 for December has to be on the table. We will get the PCE inflation numbers just ahead of the next Fed meeting on November 2nd, but barring a big drop in that, and it does count housing a little differently, I think you're going to see a hawkish Jay Powell in the news conference after their 75 basis point move.
Hey, Mike, great work. You're going to stick around and stay close, I know. A shocking number for a lot of you, I guess, Lisa. Those of you that were looking for some kind of downshift in the inflation story that would lead to some kind of downshift from the Federal Reserve, I'll price up the markets for you, and it looks a little something like this. Pretty intuitive, self-explanatory off the back of this one. Inflation comes in hot, and equities roll over. We're down by 1.8% on the S&P off the back of a big move at the front end of the yield curve. Two's up 15 basis points to 4.44. We have taken out the highs of the year on a 2-year, and we're set to take out the lows of the year on the S&P 500 at the opening bell. In the FX market, session highs, guess what, dollar yen? 147.40. Bramo approaching 150 on that currency pair.
It pretty much sums it up. Andrew Brenner over at Net Alliance Securities sends out a note saying, will they go 100 basis points? Is that really where we're back to, John, as people talk about upside surprise after upside surprise, 2 consecutive ones, PPI not as important as CPI, but not indicating that you're seeing that sharp V-shaped decline that we were hearing about from David Kelly?
Can we touch on the politics briefly? In the next hour, I'll catch up with Brian Deese, Director of the National Economic Council. I think this was the last inflation report before the midterms. The next one comes a few days after. This is a tough spot for them.
It is, especially because you're not necessarily seeing wages keep up. This isn't leaving anyone in a good position. And what you're seeing is that the lowest income individuals tend to be hurt the most, especially with things like airplane tickets, like rents, like food, like shelter. Everything is going up, and it's making it very difficult for people to feel in a good spot.
So headline inflation comes in at 8.2%, down from the previous month of 8.3%. We were looking for 8.1. That will be your headline in tomorrow's newspaper, no doubt. On Wall Street, the focus is month-over-month core, 0.6%, in line with the previous month of 0.6%. That is month-over-month. We were looking for something like 0.4. This is hot. It's an upside surprise, and it's sending this market, this equity market, a whole lot lower. Seth Carpenter, Global Chief Economist at Morgan Stanley, joins us right now. Seth, you've had about 7 minutes to pore over the details. Your take on this one, please.
Yeah, absolutely. So I have to say, I'll crow a little bit and congratulate my team. So our U.S. economics team, Ellen Zentner, the chief, Julian Richards, who works for her, we were above consensus on our call for this print. I think the stickiness that you saw in the shelter inflation was one of the key things. And so clearly a shock for the markets. The markets are off because of it. But for us, this actually didn't come in very different from where our forecast was. There is persistence, especially in the services side of inflation. The apparel number I thought was particularly useful, though. For a long time, we and others have been talking about inventories, the pullback of the consumer from consumer goods. We're starting to see it. The challenge, obviously, in this context is it's when other bits of inflation, as Lisa pointed out, are just going up more strongly.
Right now, we're seeing the swaps market price in a peak policy rate for the Federal Reserve of 4.85% in March of next year. Seth, is that what's required for the Fed to move fast, to continue moving into next year, despite some of the concerns about financial stability?
Yeah, I'm not sure that is what's required. That's a little bit above where our call is for the peak rate, but only by a hike or so. I think there's two-way risk with that outlook. We have seen the last jobs report was good, but still softer than the one before. And so if we get that downward trend continuing in non-farm payrolls, if we get down into the 100-something range, I don't know that it's going to be obvious to the Fed that they need to keep going all the way up, closer to 5%.
Seth, I'm struck by what you said. There's certain other areas outside of shelter that were stickier. And I'm thinking about airplane tickets. People saying that after a while, people wouldn't be willing to pay for something that often is a discretionary expenditure. You could see this with IKEA and Pepsi all raising prices and still having pretty good sales. Are you concerned that your team and that you have been a bit too sanguine about how quickly inflation could come down on the other side, about how pervasive even the wage stickiness is right now?
Absolutely. If ever there is a time for people who do economic forecasting to be humble, this is it. It's very, very difficult. The sort of falling off of inflation for core goods has taken so much longer than we expected. I think there's a lot of uncertainty here. The fact that the labor market is in fact cooling. We obviously got the JOLTS data a couple weeks ago that the market reacted to. We got non-farm payrolls that was solid but still coming down. I really think that part of the economy is going to be key. Can the Fed continue the tightness, get the overall economy to slow down, get job creation to slow down? That, I think, will be the key to where inflation goes over the medium term.
If you're just tuning in live on TV and radio, you missed the fireworks. Core CPI in America coming in at a 40-year high. Inflation coming in hot. Equities heading south. We're down 1.8% on the S&P. Yields up at the front end of the yield curve, up 14 basis points to 4.43, and expectations high going into the Fed's next meeting. Last time they met, Seth, in the minutes yesterday, they said the cost of taking too little action to bring down inflation likely outweighs the cost of taking too much action. Seth, do you anticipate when they meet again in November, they'll be thinking the same thing?
I think they will be wringing their hands quite a lot. This was obviously an important data point, but it was one data point. The minutes also pointed out that at some point they're going to have a discussion about calibrating the size of the rate hikes because they don't want to go too far and do too much. So I think they're getting to the point now, once we get close to 4% or over 4%, I think they really will be weighing both sides of that coin. The strength of the underlying economy is important, but inflation here is clearly strong. There was the point about used car prices having come down, but new car prices staying strong. I think it's exactly those sorts of frictions that are going on in the goods and services market that is presenting such the conundrum.
Well, there's a lot of friction right now in this bond market, let me tell you. How far can we push this up? 16 basis points, Lisa, on a 2-year, 445.
I'm watching this, and now we're at 445.3. I mean, it just keeps going up higher as the terminal rate now is looking at 4.85%. It is moving closer to that 5% handle that we heard about from Larry Summers, that we heard about from Bill Dudley, and people laughed.
Can I just say Bill Dudley said that in the summer of 2020.
He nailed it.
He was talking about maybe, summer of 21 rather, he was talking about maybe they'd have to go a whole lot further than people thought they would. Stacked lineup in the next hour for you. Mona Mahajan of Edward Jones, Jim Karen of Morgan Stanley Investment Management, Tom Kennedy of JP Morgan, and Brian Deese of the National Economic Council, the director, The View from the White House, on a tough, tough day for policymakers, Lisa.
I'll let you run off and get to it, and I cannot wait to hear those interviews, in particular with Brian Deese, and we're still with Seth Carpenter of Morgan Stanley. I would love to get your take, Seth, on the political element of this, particularly as we heard from our own Michael McKee, that energy prices outside of gasoline were rising. We've seen this with diesel. We've seen this with heating gas, with natural gas, heading into a winter where inventories are at historic lows. How much are you concerned about this triggering a new bout of inflation, even at the headline level, that could pose a real problem?
I think it really could, and at the headline level, I think there are no two ways about it. There's the winter weather is going to matter a lot. I think this is an issue that our friends across the Atlantic and Europe know even more. If they have a very warm, very cold winter, it's going to be disastrous for them in terms of their supplies of natural gas. But no question, energy prices are susceptible here, and the average consumer doesn't look at core the way the market does. The average consumer looks at the things that they're just spending money on and that they see on a day in and day out basis. And food and energy are very high on the list for the average household.
And Seth, you were talking about the bifurcated nature of where people are spending money. And I wonder how much this speaks to the uneven fortunes of people with money and people who don't have as much, about how people at the higher ends are able to buy new cars, and big ones at that. What I hear from a lot of executives is correct in the auto industry, while other people can't afford the same kind of groceries that they had in the past. How does this end, Seth? I mean, what is the sort of trajectory for the overall economy versus the pockets of potential pain?
It unfortunately tends to be the case with every downturn in a business cycle that the people at the lower end of the income distribution tend to fare worse, and so it ends up exacerbating a bunch of the inequality. If we think about the story that was so popular 6 months ago, 9 months ago, about the amount of excess savings in the economy because people weren't spending as much during the worst part of the pandemic and the government transfers were strong. It does look like, from the estimates that we've done, most of that excess savings has been spent down for people in the lower quintile, maybe the lower 40th 40 percentile of the income distribution. Not so for the top of the income distribution. So again, that's another place where we are seeing this disparity really showing itself.
And helping to perpetuate some of the inflation. Seth, stick with us for just a moment. I want to go back to Michael McKee in Washington, D.C., just to bring you the latest if you are just tuning in. CPI, the core level, reaching the highest levels in 40 years since 1982 at 6.6% year over year, higher than expected. Even headline came in higher than expected, albeit lower than its recent highs. Over the past few decades, Michael McKee down in Washington has been parsing through all of the details. We talked about how used cars have actually declined, but new ones have continued to rise in terms of their pricing. What are some of the details as you continue to parse through this, Mike, that you think will shape the conversation?
Well, I think it's, in general, the overall number of things that went up. When you look at the list of the breakdown of everything in the CPI, most everything under the apparel category fell, but that's the only one that shows anything like that. Services outside of energy up 0.6. They're up 6.7% for the year. That is not what the Fed wants to see. That's driving the core higher. And the part of the problem is they haven't yet been able to get a cap on expectations by businesses that are raising those prices. We'll see if that starts to come through. And then, as you were talking about with Seth, I think the natural gas issue is one that's probably going to come back and bite people as it gets colder, as gas use gets more significant, as we sell more gas overseas. There are already some people on Capitol Hill saying maybe we should cut off gas sales to Europe, and so especially because of Ukraine. And so there's a lot of political stuff that's going to go into this as all the world's central bankers and finance ministers gather here at the IMF for their meetings. They'll be talking about the U.S. because the U.S. inflation is so high, the Fed has to keep going, driving the dollar higher and affecting everybody around the world.
Mike, thank you so much. Great work as always. Stick with us. We will be heading back to you shortly. Seth, from your perspective, right now the market's response is pretty fierce. You're seeing a sell-off accelerate in stocks, in bonds. In stocks, you're seeing the S&P down now 2.2% ahead of the open. NASDAQ down almost 3% after already a very difficult year. At what point do financial stability concerns start to play into this at a time where inflation is still so obviously a major concern?
So I think the sell-off in equities as one example is something that my colleague Mike Wilson has been calling for. The key for the Fed is slowing the economy enough to get rid of these inflation pressures, and so marking down those earnings expectations is going to be key there. And so that goes into the level of prices. But it's not the level of these asset prices that I think are the financial stability concerns that the Fed will raise. It's how volatile things are. Is there some part of a market where things are starting to break? Is there, if we see credit spreads widening, well, with a slowing economy, maybe that's what should happen. What they're going to be more concerned about is, do they move wider in very, very short order? So something along the lines of what we saw in the UK a week and a half ago, where you saw a huge move inside of a single day. So far, we've just seen what seemed like the normal reactions, the repricing as the data come in. I think the Fed's really more worried about volatility or a lack of liquidity.
Although we're seeing in the auctions, the Treasury auctions over the past few sessions, we've seen in certain sessions of trading, there has been incredible volatility, particularly the early hours over in Asia, over in Europe. How much are you getting some sort of pats on the back from some of your colleagues over on the trading desk at Morgan Stanley, your colleagues at the Fed where you formerly worked, saying it's starting to get a little bit more dicey?
Yeah, no question. I think everyone in markets is talking about exactly that phenomenon. But I think for the Fed, they're strapping themselves in for this. They're sort of expecting some increase in volatility because the world is uncertain. I don't suspect the folks at the Fed yet see evidence that there's something that's not working in markets to the point where they're worried about it.
So given that, Seth, how much are you ratcheting down your expectations for growth, given that you are seeing the markets sell off but not necessarily dysfunction, that you're seeing certain types of inflation come down but not nearly enough to give anyone comfort?
Absolutely. So our baseline view for the U.S. Next year is very, very weak, only roughly in the 0.5% range. So that's a pretty pitiful amount of growth. I think another metric to think about that is we're looking at job growth to slow down to the 50,000 or so per month range, which is a far cry from where we are now, and particularly far cry from where we were 6 months ago and a year ago. So growth has to come down a lot if the Fed is going to contain these inflationary pressures, and that's going to be be, in the words of Chair Powell, economic pain.
Seth Carpenter, thank you so much for all the time that you've spent with us this morning. Seth Carpenter of Morgan Stanley down in Washington, D.C. with the rest of all the policymakers and many of the people here at Bloomberg. Just to really reiterate what we're looking at right now, the sell-off that is deepening in U.S. markets in the heels of a worse than expected, a hotter than expected inflationary read. Mike has been pouring through it. There is some talk about with the financial stability issues, Mike, that there will be discussions of perhaps stopping some of the quantitative tightening early. From the policymakers that you speak with, how much is that on the table?
It doesn't seem to be on the table. At this point, they're not seeing, they say, any signs of real stress in the U.S. economy, nothing like what's been going on in the U.K., and they want to give it a few more months and see what the bump up to $95 billion a month in roll-off is going to do. There are people who suggest that the Fed needs to start looking at this because not just the Fed, but the government's involved. As the Fed backs off, the Treasury is selling even more debt to pay for everything that we owe, and the markets may not be able to absorb all this. So that's going to be something that will be discussed here at the IMF and World Bank meetings, whether or not the Fed wants to change its views and maybe move up time to slow or taper their QT is still an open question, but right now the Fed is saying they don't want to do that.
Michael McKee down in Washington, D.C. Thank you. Right now, let's get Ira Jersey on the line. He is, of course, our chief U.S. interest rate strategist at Bloomberg Intelligence. And right now I'm looking at a peak Fed funds rate in March, at least as priced into futures markets on the terminal, 4.85% by March of 2023, getting closer to the Bloomberg Economics base case. What's your sense, Ira, of whether this is basically locking in a very aggressive approach from the Fed, because there is not the same signs that people were looking for? They have come too late of any sort of deceleration.
Yeah, so I do think that that we have to consider that the Federal Reserve is going to go 75 basis points for sure in November, probably 75 in December as well, and maybe even 50 in January at the February meeting. So I think that we are pricing for a higher terminal rate at this point. I think the two big things and takeaways from the markets, and I want to comment on something that Mike McKee just said as well. First is the market is still pricing for interest rate cuts in 2023. I think first, at some point the market has to price those out. So I think that the market will ultimately do that, but first it has to find where it thinks the final terminal rate is going to be, and once that happens, I think that we can see that terminal rate flatten quite a bit. And I think Lyle Brainerd probably has it right, where once they reach that terminal rate, they're going to stay there for 9 to 12 months at least. Which is longer than they typically have. The other thing I do want to say is market function is a big deal right now. Certainly you've seen a lot of volatility. Bid offers are wider on a lot of fixed income instruments and things like mortgage-backed securities and the Treasury market. But one of the ironies is that the Treasury Department is still cutting the amount of issuance that it's treasuries that it's issuing, because one of the ironies is, as inflation's been very high, wages have gone up a lot, and tax receipts have come in way better than anyone ever expected. So we actually have the lowest deficits now than we've had in years, in terms of both monthly and annual basis. So one of the ironies of having higher inflation is that we won't have to issue quite as much debt in order to make up for government spending, which is a little bit ironic.
Well, given the rate outlook, certainly it would be very expensive and punitive for the U.S. to be borrowing at this point. I'm looking definitely on the front end. People are starting to price in the likelihood of at least a 4.5% terminal rate for some sustained period of time from the Federal Reserve. On the long end, I find this interesting. Also selling off with 10-year yields hitting the highest since 2008, decidedly crossing that 4% threshold at a time when people are questioning whether we're going back to a low-rate regime. This is over the next decade. What's your view, and how has that changed, Ira, based on how people are responding to this news, that over the long term, this could indicate that it will be harder to get inflation under control, harder to get rates back to where they have been over the past few decades?
Well, keep in mind, we are still lower than the past few decades. If you go back to the early 2000s, we had, 10-year yields were 5-6%. So, still in the historical context from the last half century, interest rates are still on the relatively low side. It's just not as low as they had been, obviously, the last 10 or 12 years. I think that the longer end of the yield curve, we will ultimately see interest rates below 3% at some point. I don't think we're going back necessarily to a zero handle on front end interest rates, at least any time in probably in the rest of my career. But we will probably see the long end rally at some point as we do price in for the Federal Reserve to cut interest rates. Keep in mind, like the higher the higher inflation goes, the higher likelihood we have of a very hard landing. And because the Federal Reserve will have to crimp down on demand by increasing interest rates, continuing its quantitative tightening programs, and that just means that we're going to have a harder landing later. And that means at some point, I think the long end of the yield curve will be pretty attractive. And I do think actually in the fourth quarter of this year, we will see the peak in yields. Whether it's at 4.25% or right where we are today is still obviously a matter of debate. I thought it would be closer to where we are right now, but obviously we have new data, so therefore we have to consider this new data in our forecasts.
Ira, thank you so much for being with us. Ira Jersey there of Bloomberg Intelligence. Still with us down in Washington, D.C., Michael McKee, who's been parsing through all of the data and preparing for some pretty hard conversations, especially if Ira Jersey is correct in saying this is setting us up for an incredibly hard landing. How is this going to be communicated? At what point have people talked about actually putting a recession as a base case in the Fed forecasts?
I think a lot of people on Wall Street are putting a recession as a base case. The only question, as Ira brought up, is how hard it's going to be. The Fed has started talking about pain in the economy and that you can't get away with just raising rates and nothing happening, and I think you'll hear more of that. The Fed is going to emphasize the length of time they keep the Fed funds rate at its terminal point rather than where that terminal point is. The market's repricing right now, but it's hard to really put a finger on exactly where they need to go, how high they need to go. Their estimate has been that it would be about 4.5% to 4.75%. Some say 5%, but in that range. And does this really change that as much as people might think, since the Fed knew this would be a high inflation report and it's going to take time for inflation to come down? So Wall Street will debate this idea of raising the terminal rate, but for the Fed, it's going to be more a question of how long they keep the terminal rate up before they start cutting. And I know, Lisa, if you take a look at the WIRP function on the Bloomberg, something very interesting has happened. Ira says you got to start pricing out the idea of a rate cut. It's still there, just slightly, but now the market is pricing in a rate cut at a rate increase, another rate increase at the end of 2023. So there's some confusion in the markets about what the Fed is going to do at this point. And of course, Fed fund futures lightly traded, but it's an interesting change in the perspective of those who are trying to bet on where the Fed will be a year from now.
Mike, I was reading through the minutes yesterday of the previous FOMC meeting, and it was notable that there was a slight nod to the rest of the world, this question of some turmoil and how that will rebound back on the U.S. economy and cause issues domestically. How much is that gaining traction at a time where I'm seeing the euro once again fall versus the dollar, 96.68, dollar strength pervasive in the face of persistent inflation?
Well, it's obviously a major topic of conversation around here. The Australian treasurer says he's going to bring up to Jay Powell, watch what you're doing to the rest of us in the world. But most of the central bankers I've spoken with say they understand that the Fed has a domestic mandate, as do they, and they can't do a whole lot about it. They just have to let it go. And so the Fed is going to take this into consideration. One thing they have to take into consideration is how much this global tightens credit in the United States, so they may not have to do as much as they think if everybody goes up. But at this point, they know they're doing it. They know the rest of the world is tightening, but everybody has to do their own thing.
Michael McKee, thank you so much. As always, right now we're seeing the sell-off continue to accelerate into the open. Right now we're looking at the NASDAQ down near 3%, the S&P down about 2%, dollar strength, yields higher, bond prices lower, the 2-year yield hitting 4.5%, on the 10-year solidly north of 4%, the highest levels going back to 2008. CPI coming in hotter than expected with core levels at the highest going back to 1982 on a day where people are looking to the Fed to understand exactly how this will be dealt with. Coming up, we'll hear from Kristalina Georgieva of the IMF. This is Bloomberg.